What is going on, everybody? Happy Wednesday. Happy hump day. We've got an exciting show planned today. I'm really excited for this. So at noon Eastern, we will be live streaming a bull versus bear debate. I don't know if you guys saw, but our friend over at the Bear Cave, Edwin Dorsey, last week put out a short report about a company that we're also friendly with, ticker RICK, RICK, RCI Hospitality. Of course, we had the CEO for RICK, Eric Langan, on a couple weeks ago. If you guys don't recall, it is the company that owns and operates different gentlemen's clubs throughout the country. So Edwin Dorsey put out a short report on RICK last week, and we are going to have a live debate. This will be hosted on Twitter Spaces, but we will be live streaming the space here as well. Edwin Dorsey will be debating against. So let me go ahead and get this Twitter Space pulled up. And I'm really excited about this because it's not often that, someone puts out a short report and then people actually agree to do a live debate with that short report. So at noon Eastern, again, it's going to be Adam Wyden, who is one of the biggest investors in RICK. You might be familiar with Adam Wyden. He's had a pretty successful career in investing. He manages, let's say about $300 million, almost $100 million of his own money. His dad is actually a senator out in Oregon, I believe. There was a big Forbes article about Wyden's investing. So it'll be, and he's kind of he doesn't hold back. So it should be a very interesting debate, kind of going against, again, Edwin Dorsey, who wrote the short report against RICK, will be arguing with Wyden, who is one of the biggest investors in the space. The space will be moderated by Mark Moran from Liquidity, who is awesome and amazing. So again, it's just going to be a very, very fun piece of content, because it's not often we get these live bull versus bear debates, and it's even more rare to get it in a manner that's really targeted and aimed at retail investors. So the fact that they're doing it on Spaces, to me, is awesome. You guys can, I'm sharing my Benzinga Pro screen right now. You can see me. I'm checking out Tesla right now. If you guys were watching live trading, I do have a live open trade on Tesla that we can discuss after we get the show started. But before we play the intro and everything, let's just do a quick check-in on the overall market. The S&P 500, the SPY ETF, is down about 0.1% right now, so pretty flat. The Qs, on the other hand, are up nearly 0.5%, so Qs having a good day compared to the overall market right now. Of course, driven by some of those big tech stocks, right? Whether we're looking at Netflix up 4%, Roku up 10% on some potential acquisition news. We can check in on our Robloxes, kind of that the growthy side. ARKK up 4.5%. So I don't know what's going on in the market today other than that. Obviously, the strength is in tech, into some of these growthy stocks. But again, I'll be continuing to check Tesla. We'll talk about that trade. We'll do some more touching on RICK and that short report before we come on. And so the plan is, I think what's going to happen is I am going to actually join the space from my phone at the beginning, and I'll be streaming the space live here so we can watch it here, and I'll be giving some live commentary, and I'll just be muted on the space, but we will be helping out on that space, hosting the space with them. So again, just shout out to Liquidity, shout out to Mark Moran for setting this up, shout out to Edwin Dorsey for agreeing to do this, because it's hard. It'd be very easy for him to put that short report out and just stand by it and not want to defend it in any debates or anything, but he's willing to do it, which I think is awesome. So let's go ahead, play the intro, get the show started. Once we're back, we'll be running through some more tickers. I'll take some tickers from the chat. And yeah, go ahead and smash the like, subscribe if you have not already. Let's go ahead, get the show started.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojasek from Trend Spider. We have a
breaking news. Alrighty, so like I said, I'm watching Tesla right now. We got up to this level. Our basically our high of the day was right around 750, 749.89. So we've gotten up to 750 now, or tried to get up there a few times and rejected each time. On this last leg that we were moving up, Tesla rejected pretty nicely for me, holding these puts, came all the way down to around 737, but you can see I'm looking at 2-minute candles right here. So for the past 8 minutes, we've just been moving higher. Now I'm going to switch my screen over to my Robinhood where we can check out the actual trade. And it's been an interesting trade because I got in at a very good time. And for a while, for basically the first like 20 minutes I was in this trade, I made an immediate like 20% and could have sold, but I did not. So as you can see, let's pull up Tesla. Or actually, let's pull up the actual put. So I bought the puts actually for, let's see, 340. They're worth 365 right now. But this is where I kind of bought them at right here, and then it went up to 445, and I didn't sell them. And basically, I have a stop loss set at I believe 300 flat. So the most I can lose on this trade is $120. But my thesis here, and I'll go back to the Benzinga Pro chart just because the chart's a little bit more sophisticated, allows us to look at the price action a little bit more clearly. My thesis here is that if we cleared that previous high of day of 750, that's going to be bad for my trade, and I'm going to be out, and I'm going to take that, $120 L, and that will be that. But if we continue to reach up here and fail to break through that 750 level, I will see that as bearish for Tesla and hold on to these puts throughout the day. Basically, I'm just hoping, we can see we've had these 4 green candles in a row on the 2-minute chart. So for the past 10 minutes, some positive price action. And we're going to see right here if we're going to continue that momentum, or it looks like we've got a red candle forming right now on the 2-minute chart. So if we can get below this level, this 737 level, I will like that a lot. And I will look at Tesla and see, see where my contracts are at, see if I should get out of them. But for right now, I'm holding on to them. I'm holding strong. We're up 10% on them right now. So just holding on to those. I will keep you guys updated what's going on with those. I went through some of the other big movers of the day. Of course, Roku up. What's Roku up to now? Roku up 12%. We can go to the news tab here and see, why this news. So inside Roku, talk is heating up about an acquisition by Netflix. This was a report from Business Insider. So Roku has long been kind of seen as a potential takeover target, right? They have the streaming infrastructure. I'm zooming out on the daily chart here so you can just see how crazy this chart is. Roku was trading at, let's see. Roku was trading at, this was pre-COVID, so we're looking at February 2020. It was about 125. We're actually below our pre-COVID levels on Roku. And now during COVID, Roku's stock went absolutely berserk, got all the way up to in the 400s, came back down to 270, and then back up. And this is kind of a beautiful double top pattern. You can see just how symmetrical it is, right? We got up to basically the same exact point on here twice, rejected it, and now Roku is trading below its pre-COVID levels, which is, it's interesting because Roku obviously was one of these companies that got a big tailwind during COVID. Their business was pushed forward. More people were streaming. But now the market is basically saying, we don't care about that. We don't care about, that your business got a tailwind from COVID. We care about how much money you're making. We care about what your growth looks like heading forward, which for basically all we've seen from different streaming platforms over the past 6 months is that streaming is not going to maintain its growth rate that it did during COVID. So all of these streaming stocks are out of favor. We can go to Netflix, and you can just see it on the chart here. Netflix is trading well below its pre-COVID levels, right? We can look at where Netflix was at January 2020, was at $320. We're at 200 right now. The market does not care that Netflix added X amount of subscribers during COVID because no one could do anything besides sit at home and stream. That's the outlook has changed. The outlook is now Netflix is actually losing subscribers quarter over quarter. They're not growing, and we'll see if that continues to be the case. I personally To me, Netflix is one of these companies that I am very, very convicted that in 15 years, right, when I'm 40, Netflix is still going to be around. Netflix is still going to be a monster. So for that reason, I wouldn't be opposed to buying some down here for a long-term investment. The problem is just in the short term, like I said, we will have to see in the next earnings reports and stuff if that outlook is changing for Netflix or if that growth rate is continuing to slow, because then we won't be able to have any positive price action. If the momentum is just still slowing for Netflix, it's not going to matter essentially how much money the company is making. We can look at some of the financial metrics here in Benzinga Pro. So the PE, actually, forward PE for Netflix, 18 is pretty reasonable, right? The price to sales, under 3, very reasonable. So this is essentially saying that if you buy Netflix here and it maintains its current revenue and everything, for, in 18 years, which is pretty, I mean, I don't know what the S&P average here is right now. It's probably a little bit above average Netflix, the PE and everything still, but for the longest time, all of these stocks, all of your Netflixes, your Apples, your Microsofts were trading at crazy valuations and now have come back to earth. I see someone talking about Tesla in the chat, so let's go back there, check it out. Again, we're looking at this. We've been looking at it on, on a 2-minute chart, which is not something I typically do, but because I have this kind of quick options trade, I don't mind looking at the 2-minute chart here. Ooh, yeah, it looks like on this candle we got back to our lows of 737, but looks like we've kind of bounced up from there. Let's see right here. This is gonna be interesting, I think, because this candle. Okay, yep, there we go. Oh, here we go. This, I mean, if you zoom in here just on this 2-minute, it looks like we could get a little double bottom reversal, some action up here. Let's check back in. I'm gonna check back in on the actual contracts. Yeah, they're up about 16% right now. What do you guys think, chat? Should I just get out of the Tesla trade, take my 16%, take the $160, or hold on to them? Because I don't mind just taking the profits and taking the trade. The problem is that, or not the problem, my thesis is that it's still, I haven't seen anything on this chart that would indicate to me that, Tesla won't keep moving lower. Like, it looks like all these bounces we're getting are just little bounces in a bigger downtrend from this top point of 750, right? Until we break 750, I'm not bullish on Tesla's intraday action. Yeah, 30 saying Elon's due for another weird tweet. I mean, Elon could tweet anything right now, and depending on the tweet, could have a impact on Tesla's stock price where it goes up or down. So when I'm holding these contracts, I'm kind of beholden on. I'm kind of reliant on whatever Elon Musk is going to do or whatever he's not going to do. All right. Let me know what everyone else is watching. I see 30 talking about CEI, Kaylor Energy. This is not a stock that I've talked about or we've looked at in a while. Looking at the daily right here, you can see we've got this huge spike back in March. Got all the way up to highs of around $2, and now we're trading well below $1, 60 cents. This was actually a Zach Morris favorite. If you guys know Mr. Zach Morris on Twitter, part of Atlas Trading Group, was talking a lot about CEI. But the thing that I don't like about CEI here is, all right, we're looking at the daily chart right here. Look at this chart since that day where it got to $2 in March, and look at just kind of how it hasn't really been doing a lot. It's been bearish. It's been down, and let's compare this to the XLE, right? The energy ETF, Kaylor Energy Inc. This company, is active in the oil and gas market. The company is engaged in the acquisition and development of crude oil and natural gas from various known productive geological formations. The company operates exclusively in the onshore United States oil and gas industry. So this is like this is like a pure play oil and gas. But if we look at the XLE, all right, wait, hold on. Let's do this again. Just take a mental picture of this chart right here. From March, what the chart is doing, what CEI is doing. And now let's compare that to XLE in that same time frame, right? March 8th, where my cursor is right here, is right where that big candle for CEI was, where it got up to $2. Look at what the XLE is doing since then. Just been on an absolute tear, going from 78 up to 93. Just incredible run for the XLE here, led by companies like Chevron, XOM, you name it. All these companies have been doing super well. So the fact that CEI is doing the opposite of all these companies that are doing really well is a big, big red flag to me. And I know that CEI is not your Chevron. It's not your, it's not in your XLE. It's not going to be part of that sector in that sense. But if it's in the oil and gas industry and it's not doing well while all the other companies are doing well, that's a huge red flag to me, right? And that goes across the board with any industry. If tech is super hot and there's some technology company out there that is not participating in it, then I want nothing to do with that stock, because that's showing me that even while the industry that it's in is strong, investors are overlooking this stock. Investors are saying, no, we don't want that one. I don't want CEI. I want Chevron, or I want Exxon. I don't want CEI. So to me, for that reason, CEI is just not interesting at all. Let's check in on Twitter. I see Christian Gallagher asking if Elon has backed out of the Twitter deal yet. So Elon's come out this week and basically said that he's going to try to walk away from the deal unless Twitter can prove that its assessment that 5% of its users are bots is legitimate. Now, here's the problem with this, and this is coming from Matt Levine, who's a great, he's a former M&A lawyer. He writes for Bloomberg. He's a great columnist. He's a great follow on Twitter. Matt Levine, love him. Basically broke down what Elon was saying and saying, like, that's great, but here's the legal problem with that, is that contractually, Twitter's thing where they said about 5% of users are bots has always been an estimate. They've never said this is definitive 5%. It's always been an estimate, and the way to calculate this, the way to find the actual bots is there's no objective way to do it. There's all these different, strategies, programs you can run, whatever, but there's not like one decided method in finding how many bots there are. I think Elon put out his own way they wanted to do it, where they would grab like every 20 tweets and test, whatever. So either way, the methodology in actually finding how many bots there are on Twitter, Matt Levine is saying that specifically is enough of a legal kind of, there's ambiguity there that it wouldn't be easy for Elon to say definitively, they're breaking their clause here, I can get out of the deal. And Twitter, on the flip side, has said, no, we're going to go ahead and enforce the $54.20 price, agreed upon price. So Twitter's coming out and saying, while Elon Musk is saying, oh, I'm trying to back away from the deal, Twitter's saying the opposite, where they're saying, no, we are going to enforce the deal. The other part that you have to think about is, even when Elon first was talking about buying Twitter, one of the things he was talking about was getting rid of the bots. So that ruins part of his legal argument of saying, I didn't know there was a bot problem on Twitter, when he was literally saying there's a bot problem. I want to buy Twitter to fix this bot problem. And then he's going to say, oh, I don't want to buy the Twitter, there's a big bot problem. Like, yeah, no shit. You already knew that. You said that. There is the $1 billion. So if the deal does, walk away, Elon will be on the hook essentially to pay Twitter $1 billion. I don't think that's Twitter's goal here, because Twitter's trading at $40 right now. $40. If it weren't for this Elon Musk deal, who knows where it'd be at? It'd probably be $30 or under $30. So the idea is that Twitter now, the board is saying, oh, holy shit, this is actually a great deal. $54 a share when we're trading at $40. That's a lot more than $1 billion. So, they're not going to want to settle for this $1 billion settlement. They're going to want to go ahead and get the deal pushed through, because that's going to be a lot more lucrative for the company, for the board, for the company's shareholders than this $1 billion buyout. So it'll be interesting. It seems to me like this is most likely heading to some sort of arbitration, some sort of legal proceeding where there'll be a bunch of fighting over the bots, over what was decided upon, over the deal. But at the end of the day, Elon Musk signed a deal or agreed upon a deal to buy Twitter at $54.20 a share. And now he's realized that he's vastly overpaid, and he is going to try to get out of it. Time will tell. And DG, I don't disagree with that. I don't disagree with that. the Twitter bots here. I'll pull up I'll pull up DG's comment. The point is there's more bots than they disclosed, and Twitter is responsible for that. Again, I don't disagree. If Twitter's saying that 5% of their users are bots and it's more than that and they know that, that's not good on Twitter, right? That's not good to their shareholders. That's not good to, potential investors. But what Matt Levine is saying, and again, he's the M&A legal expert, not me, is that that's great. That's a legitimate argument. But legally, Twitter never put this out there as 5% hard fact. That's, it's always, oh, this was an estimate, and the way that we measure this isn't perfect. So that leaves a lot of legal ambiguity where they can say, well, yeah, you knew we said this, but you knew it wasn't a legit number. It was just an estimate, and we know that our methods are going to differ from how we find it. So basically, Matt Levine is just saying that it's not a good enough legal reason for the deal to fall through. Obviously, Elon disagrees. Elon's the richest man in the world, so I assume he's got some good lawyers, and we shall see. Where do you think the bot percentage? I honestly don't know. I know the Washington Post actually did a report on specifically Elon's followers and found that like 50% or some crazy amount were bots. So if that's the case, and that holds true for other people outside of Elon, then yeah, that number is going to be a lot higher than 5%. I'd if I had to guess, I would guess somewhere in between like the 10 to 15% range. I think 20% sounds very high. I'm very active on Twitter, and I like know a lot of the people I follow. If not personally, there are people like Matt Levine that I follow, and I know when I see a Matt Levine tweet, it's Matt Levine. It's not a bot. And you can go to like someone like Elon Musk's tweets and go to the replies, and in the replies there are a lot of bots. But that's always been the case. Like, I don't know if you guys know, but like with Twitter, there's always been a problem where like Elon's tweets always get co-opted, or the replies are always co-opted by people saying, send me Bitcoin at this address here, and we'll send you 2 times more, whatever. Like, that's been going on for years and years and years. Twitter, for whatever reason, like for a business standpoint, it doesn't seem like that is a huge problem for them. Otherwise, Twitter would have already tried to stamp that out. Sava, sorry, let me get this name right. Saravpreet Singh is saying, at Aaron, if July earnings season is soft and slow down, then what do you feel? I'm checking out Tesla here because I still do have these puts. All right, puts are doing well, up $200 on them. I do think that it's more likely that we will see more and more. So, I mean, think about it. We've seen Microsoft and Target now come out and basically give bearish guidance saying our margins aren't going to be that strong, both for different reasons, or at least both citing different reasons. Microsoft saying, the Forex exchanges aren't going to be great. And then Target is saying that their inventory problems are going to cut down on their margins. But either way, 2 of the biggest companies getting out ahead of their next earnings report and saying, hey, our margins aren't going to be that great. So I'm expecting across the board earnings not to be great in June, July. And I do think it's possible that we haven't seen the bottom, that we, or at least that we haven't seen the bottom, that we could come down again and test those bottoms. But overall, I remain bullish long term. Obviously, like I'm investing every 2 weeks when I get my paycheck, a certain amount of that goes into that. So I remain bullish. All right, guys, wait, hold on. It's game time. Wait, we're going to, I remain bullish in the long term, but short term, I am more worried that we will see another downturn. All right, wait, Rohan, I might need some help here. So I'm going to stream. Can we stream the space from computer, or can you only do it from your phone?
The easiest way to do it. I mean, yeah, you could do it from a computer. Yeah, if you screen shared the space with audio, that would be the way to go.
Can you put a link up so we can all retweet?
Problem is,
I haven't tweeted.
Is that looks like it's not letting me join from. It's not letting me join the space online. Can you join?
I mean, why not?
Well, I know to. Okay, here we go. Now we can.
All right, nice.
It just.
I can do it from here too if you want. But let's see.
On, and then let's.
All right. Sorry, guys. We are sharing Twitter. Sharing. Join this space. There we go.
And
Do we get whoa?
We're Edwin.
Do we get audio too?
Okay, I see it. I'm gonna wait until Ed.
I feel like I'm hearing it over your phone.
And not the computer?
Well, you want to stop it on your phone so I can tell?
Yeah.
Your mic's live, Adam.
Okay, I see it. I'm gonna wait
I hear it
until
over the computer.
Edwin gets here.
All right.
Yeah, no problem. I'll just let you know it's live in case you want to mute it. Or shuffling around like.
Are we just gonna be watching this dancing sausage?
All right,
I don't know. Let's get it new.
Edwin.
Yeah. Hi, guys. Can you hear
Good.
me?
Yes.
Let me just make a comment quickly before we kind of get into this. But look, there's been some back and forth on Twitter. I know emotions are high. I went back and looked at some of your work, Edwin, and I saw you did a profile on Bill Martin. Obviously, he's one of my mentors. In fact, if I get hit by a bus, he'll be involved in cleaning up the mess for my LPs. So look, I was young once. Doing work that doesn't necessarily make sense is not a crime. In the interest of kind of a fruitful dialogue, I just want to make sure that both Mark and Eric and myself try and keep kind of the personal stuff aside, and we focus on the merits of the investment. So I just wanted to kind of get that out there. And by the way, I'm good friends with Mark also, and Mark has said nice things about you. So look, I just want to kind of get that out of the way.
Well, thanks, Adam. Bill's a great guy, and I'm excited to have a good discussion.
Okay, good.
Fantastic. All right, with that, it is 12:01. So let's kick this off. This is going to be the Bulls versus Bears debate. I know that there are a few other spaces going on right now, so feel free to tweet this out to make sure everyone knows this is the official one. But for a bit of background for those who don't know, hey, can everyone else go on mute? Perfect. So as a bit of background, Edwin released a report last week against RCI Hospitality Holdings. And then now we have Eric Langan, who's president and CEO, as well as the largest individual shareholder, Adam Wyden of ADW Capital, to debate this in real time. Now, like Adam said, there's been a few things going around on the internet. Tensions are high. So there's going to be 3 rules to this. One, we're only going to focus on Rick. There will be no other companies involved. 2, there's going to be no personal attacks or any character assassinations. I will not hesitate to mute any parties who are responsible. And number 3, let's have some fun. I think this is going to be great for everyone. In the spirit of this, let's have each side make an opening statement to talk about this. Edwin, since you are the one on the attack, I'll offer you the floor right now. And then Eric, you'll be able to start off with your defense, and we can take it from there.
Absolutely. And thanks for having me on, Mark. First, none of this is investment advice. I actually have no position in Rick and never have. But I first started looking into the company. And when I did, I was looking at it as a long. I wanted to invest in it. I was kind of excited by the stuff Adam Wyden and Yaron Neymark were saying about the company and the new bombshells concept. And what kind of irked me, or what raised my suspicion, is the more I looked into it, the less it made sense, especially around bombshells. I thought, just based on all the social media chatter, that this was a fast-growing restaurant chain that was just getting into franchising and had huge potential. And then when you dug a little deeper, it was less than meets the eye. It was kind of more bark than bite. And what I mean by that is they've been trying to franchise bombshells for 5+ years. And now 5 years later, after they predicted having dozens of open franchises, after 5 years of trying to franchise them, they still don't have one open and active franchise bombshells location. And that kind of didn't make sense, especially if the unit economics are as great as management and Adam Wyden says they are. And then you look, they're putting out press releases saying they're doing franchise agreements with the CEO's friend with this anonymous investor group. And that also raised my suspicions, like, why are you putting out these press releases doing deals with the CEO's friend? Can you not just get like a normal franchise agreement with an outside party? So just all this on bombshells started to make me like a little skeptical that this is more than just like an 11 chain restaurant in Texas with moderate success. And then on the strip club front, I thought that Rick's would be the only one kind of buying and rolling up these strip clubs. In reality, there are a few players, and Rick's isn't the only game in town. The more research I did, strip clubs seem to trade at low valuations for good reason. There's huge regulatory risks. Local governments change sentiment over time. And in my view, Rick's has value, but it's trading at kind of an all-time high multiple of EV to EBITDA. Even though EBITDA has doubled over the last 10 years, the stock is up 5x or so. And in my view, this is probably should be valued closer to a $20 or $30 stock. And I think people are putting too much emphasis on bombshells, the new NFT stuff, where all that to me doesn't have a ton of substance. And the strip club business probably has value, and that value is closer to $20 or $30 a share, not necessarily the 60 it is today.
Great. Thanks so much, Edwin. Now, Eric, we'll let you go. And then Adam, if you'd like to, after Eric's done, feel free.
Yeah, well, let's start with Bombshells franchising. We jumped into franchising way too early. We're new to the restaurant business. We had no clue what we were doing. I'll be the first to admit it. I know the bar business. I know how to sell lots of alcohol. And that's what Bombshells was doing in the early days. We brought in a restaurant expert, David Simmons, who's our director of operations for restaurant division, experience at Brinker, experience with Planet Hollywood, and he created the menus, the food items, names, and really brought the Bombshells concept to life as to what it is today. Again, we were new. We were thinking in strip club terms, build it and they will come. So we did a couple of early locations that I would call Class B, Class C restaurant space. Now that I understand the restaurant business so much better than I did 10 years ago or even 8 years ago. And we've made those mistakes. We've learned from them, and we've moved on. Now, when you talk about franchising, we hired somebody who we brought in early who had made us big promises on what they could deliver. They were unable to deliver. We ended up letting that person go. We moved on. We said, we've got to get to a certain size before we really push franchising again. And so we did. And we've talked to lots of people. We could franchise very rapidly, along the tunes of Tilted Kilt and some of the other restaurant type chains that have grown faster than us. But they also are at a point right now where they're opening 10 restaurants and closing 10 restaurants every year, and have basically stalled out their growth. We've only closed one store ever. It was our second store we ever opened. It was a C location. Today, I wouldn't even drive by that location to look at it, let alone consider leasing and building a Bombshells there. Our last 4 stores have been hugely successful, $7 million units, because we've learned Class A restaurant space. We've learned those demographics. We've signed up a true franchisee in our first franchise group. One of those franchisees owns over 60 pizza restaurants. They know what they're doing. They have had some issues with supply chain, getting their store open on time. Was supposed to open, many months ago, but they are very close. Training starts on the 13th, which is next Monday. They'll open the doors on the 20th is the current plan. So that store will be open. And as far as franchising with someone who I consider a friend, absolutely. I know his ability to operate. He has multiple locations around the country. He's a great operator. He's got a great person who we're going to train through our management training system, who will be his main operator. And Huntsville is an incredible market, and he's found an incredible location in that market that I think will be hugely successful. We are talking with several other people about franchising, and we hope to grow the franchising side. But the real story is the internal growth, and we're going to open 6 company-owned stores a year. I think that's where the real growth story is for the company. We had talked with a group about rolling into a SPAC a while back. at about a $280 million valuation.
All right, guys.
And we
So
said, well, if we can get this thing to
this
50
is
million,
Rick's
we're 700
CEO,
million.
Eric Langan, who's been
Where
on the
can
show
we
before,
make,
coming in and kind of giving his
$420 million
rebuttal
in value for our
to Edwin.
shareholders
So
in 3
Edwin
years?
runs the Bear Cave. He puts out a short report every week. Edwin essentially saying his biggest issue has been with the Bombshells franchise, which is like a Hooters-esque type franchise that Rick's is running, and Eric's giving his rebuttal on that.
Mine in the strip market, there always has been. And I'm not saying that. I say we're the preferred acquirer because we have access to capital. Most of your other people that are buying the higher end strip clubs, similar deals like we're doing, are mainly owner finance, very little cash down, and it's really a true manage to own on about 100% of the deal. Or you might see some smaller acquisitions that are cash. And there's no doubt. And what I would say is, if you look at the 2 other large companies, Spearmint Rhino, Deja Vu, both have been in the business even longer than I have. And both were huge when I started, and they're still about the same size or a little bit larger. And yet we've grown up, to almost 300 million in revenue. And so that's what the public market does for us. That's what that credibility, our audited financials, and our strong cash flow has been able to do for us. To say the stock's worth $20, $30, you really misunderstand the company. You really misunderstand the cash flow. At 100 million in EBITDA, that should put our cash flow. Let's see, let me do the math real quick here. Probably in the 60 million range. So you're saying we have 900,000 shares outstanding. So you're saying that our company is worth less than 5 times cash flow, and at $20 a share, you're at 3.25 times cash flow. Where we all know strip clubs are trading at 3 to 5 times EBITDA, even in your other transactions. Nobody's taking less than 3 to 5 times EBITDA. So I think you're way off on the $20 to $30 stock price. Don't know if that's my 3 minutes, but it's probably pretty close.
Fantastic. Now, Adam, we're gonna let you loose.
Yeah. No, look, like every great shareholder, I don't agree with Eric on everything, and I actually disagree on franchising, broadly speaking, and that's only because I think that I'll take Bombshells first, and then Nightclub second. But what I would say is that I actually think that if you look at the total assets of Bombshells, now obviously there's it's 55 million. You're doing about $15 million of EBIT last quarter, right? And you were hit by Omicron in that quarter. So my guess is, normalized EBIT. Well, last quarter you had pre-opening costs, right? And you had Omicron. So, my guess is that normalized EBIT for Bombshells is probably closer to 20 million. And so my question to you is, I've got 20 million of EBIT, right? With $55 million of assets, right? So what is that pre-tax return on invested capital, right? That's about 36%. Okay. That's really freaking good, right? It's so freaking good that we probably shouldn't be doing any franchising. But as Eric knows, right, every market is different. And I think his strategy around franchising is, if we can get into Alabama and some other markets, right, we try it out with the franchisee, right? They make the investment. If the market works, then we can kind of do company-owned stores anyways. I mean, I think, these franchising is really kind of a low-risk way to get into new markets. As you can tell, right, the franchising is largely outside of Texas, right? The vast majority of the Bombshells are in Texas, a market that Eric knows really well. I suspect if there was something in Miami or something else where we had company-owned assets, my guess is we would go the company-owned route. So I think, I think Eric would tell you himself that this has been a labor of love, and he's made an enormous amount of mistakes since he started, right? I think he'd be the first person to tell you that, whether it was going into Vegas and going into a market he didn't understand and having to sell it and go and buy back stock, right? I mean, look, I think Eric, like most entrepreneurs, right, is really kind of a lot of what you're doing is trial and error. But I think ultimately the sum total of what he has done, going from $1 million to $100 million of EBITDA, right, creating a huge, company-owned real estate portfolio, and then effectively de novo creating a scratch kitchen, restaurant concept, I think is pretty remarkable. And so, what I would say is, and not to mention, I think what is massively misunderstood is Eric's ability manage his real estate. I mean, you know, owning all the real estate under Tootsies and Scarlets and some of all these things is an enormous inflation hedge. Not to mention that, you know, part of Eric's marketing strategy on Bombshells has been, you know, buying pads, you know, having Bombshells be the anchor tenant, right? And then selling the real estate to other developers who are going to drive traffic to that Bombshells while lowering his cost, right? And so, you know, I think, you know, I don't know if you know, maybe you talk to Bradley or Eric to go, you know, one by one some of the assets, but, you know, our understanding is that in some cases they'll buy a pad, they'll subdivide it out, lower their, you know, basically their cost to develop, and then, you know, has a marketing engine to drive traffic. So, you know, I think Eric would tell you that like Bombshells hasn't been perfect in terms of execution, but I think if you look at the EBIT relative to the assets, right, you know, and that's going to give you an idea of kind of the unlevered cash on cash return, right? I think it's been very, very good. And so, you know, I think, you know, cautiously, I think Eric should continue to grow those Bombshells because I think it offers great returns on invested capital. I think it offers another business. You know, I think I don't know if I said this on some of the other spaces, but, you know, I own Buffalo Wild Wings pre great financial crisis, and found that was actually a very nice counter-cyclical business, right? In terms of people going to games less and drinking more and going and doing that, and it held up very, very well in a recession. So I think it provides kind of another income stream. I think, as Eric, you know, initially said, it creates another asset that could eventually be returned to shareholders, either in a sale or a spinoff, right? And so, you know, again, he built this thing from scratch. I think the returns have been good, and, you know, I think, you know, the franchising thing I think is nonsense because, look, at the end of the day, it's only an 11-unit chain. I mean, how many 11-unit chains that have a $6.5 million development cost are successfully franchised? I mean, that's a huge nut. I mean, you look at a Subway or a McDonald's, I mean, the cash investment up front is very, very low. So, like, I don't think you guys should be penalizing him for not franchising it. I mean, it's very much a small business with high capital costs. And so the short answer is the company has executed very well on their company-owned segment. You know, I think, you know, they can continue to execute on that. If they want to test out new markets through franchising, I think that's fine, but I don't think they need it. So that's my answer on the Bombshells. On the strip clubs, what was the knock on the strip clubs? The strip club knock was what?
They deserve to trade at low multiples.
Okay, so let's talk about that for a minute. All right. So why do strip clubs deserve to trade at low multiples, right? Well, you know, not all strip clubs are created equal. Let's start with that, right? So some strip clubs are not, like, if you look at a Tootsie's or something, or a Scarlet's or something. Well, first of all, you know, I would say that stuff in Vegas, stuff in New York, stuff that has a very, very high-end component with, like, Wall Street. Like, so for example, you know, in 2008, right, you know, Eric had a lot of Wall Street. He didn't have a lot of Florida. He had Texas. And so when Wall Street blew up, you know, you lost a lot of service revenue. Now he managed through it. And so, like, you know, again, like any other income producing asset, you want to understand what the growth of that cash flow is and what the durability of it is, right? And so what I would say is that, you know, New York has, you know, more or at least historically has had more service revenue. It hasn't come back yet, right? But I mean, you look at Florida, you look at Texas. I mean, Texas has got great boons to oil, right? The oil patch is doing well. That to me has been a drag on the company's financial results for the last several years because oil's been down. And so now all the oil guys, the Wildcat guys, have more money. So that should provide a nice hedge because those guys are benefiting from inflation. They're making more money. And so they're going to be going to the working class clubs. You know, Florida, I think, is kind of look, I live here. I think there's an enormous amount of people moving to Florida because of low taxes, right? You know, and you'd say, well, Bitcoin's down, but it's not just Bitcoin. It's all different types of people. It's real estate people. It's wealthy people, right? I mean, look, you know, I think I've been pretty clear about my comments about unearned taxes and stuff, and you can Google that. But, like, look, coming to Florida is basically Florida and Texas are really the only places. Otherwise, you got to go to Nevada or New Hampshire, right? Like the only civilized places where there's really, or Wyoming, you know, urban, you know, look at Oracle in Austin, right? I mean, Texas and Florida are two markets where we have a great presence, where you have just unbelievable income demographics because companies are moving here because it's cheaper, right? The cost of living is less and the after tax. So you get a double whammy, right? The cost of living is less. And look, I live here, I know, right? The cost of living is less, and you pay, in my case, I was paying 20% less. So if you have an LLC that you pay unincorporated business tax in New York, you're saving 20% on taxes. So I think Texas and Florida have unique characteristics because they have migration from other wealthy places like California. Look at Canyon Capital. Josh Friedman moved to Dallas, right? Oracle moved there. You have Icon, you have Orlando Bravo, you have all of these companies, Blackstone, right? So what happens in that scenario? You have all the billionaires who come, and then you have all the infrastructure around it that comes. So all the guys who make 200 grand that work for Larry Ellison or Josh Friedman or Orlando Bravo, where do they go? They go to Tootsie's, they go to Scarlett's, they go to Bombshells. And so, the markets that we're in have wild tailwinds. Okay. So let's start with that, right? Not to mention, right? These are like, use Tootsie's as an example. I mean, Tootsie's is a massive freaking sports bar, right? I mean, it's open, you go there at 2 p.m. and people are sitting there drinking, they're watching games. I mean, it is not your traditional New York VIP gentleman's club. And so, the transactions that have been taking place in general, I don't know what the multiples are. Again, I'd have to look at your transaction comps. I'd have to look at what they're buying. Is it including the real estate? But I think what Eric would tell you is, he is able to buy clubs, at about 4 to 5 times EBITDA with the real estate. Okay, so let's start with that, right? You can buy a club at 4 to 5 times EBITDA. Chances are, if it's a small club, right, you do not have necessarily the marketing engine, the point of sale, the ERP, the optimization. I mean, look, obviously what Eric has shown, and I think you'll see in the results for Lowry, VCGH, is that when Ed and his team comes in and they get the pricing right and they get the promotions right, and the Denver clubs, they're rebranding some of them Scarlets, they're putting money into them. I mean, these guys have a formula to acquire clubs and improve them. And I'm sure, hopefully the company at some point will put metrics out on this, because I think it will be helpful. But I mean, look, we are good buyers of clubs. We create them at lower multiples, right, than what we paid for them, right? And look, when we're buying it with the real estate, right, I don't need the multiple to go up, right? If I'm buying a club at 4 or 5 times EBITDA, I'm financing it with low cost mortgage, right? And I own the real estate, right? What ends up happening in a 10% inflation world, right? If I'm running at a 30% margin, if I just raise my sales with inflation, no more price than that, my margins go up by 10%, right? So I own a wildly inflation protected asset, right? I'm basically getting a free call option on providing our Six Sigma and improvement onto these assets, right? And at the end of the day, right, like, what is the cash on cash return? If I buy something at 5 times EBITDA, right, and I do some seller finance, and I'm putting down, I don't know, 30% of the capital, I mean, the cash on cash returns are incredible. I don't even need the EBITDA multiple to go up. I mean, I think I think what is lost in all of this is that, the company has grown from a million of EBITDA to 100 with almost no equity cost of capital. I mean, the only material equity deal that's taken place in 23 years is the Lowry deal at $60, where he took $30 million worth of stock. And so, like, my point is that, like, nothing you can say about this company is going to stop them from growing EBITDA, whether it's building a Bombshells or buying the next strip club. And I think what is exciting to me at this stage in the game is that when they did the Lowry deal, he bought whatever it was, 15 of EBITDA that he turned into 20, right? That $20 million of EBITDA is more EBITDA than the entire company was doing 7 or 8 years ago. And so if Eric is successful in buying some of these larger chains and these bigger clubs, you start getting the advantages of scale, right? You have the cash flow, right? You have willing sellers, right? You have their, willingness to take stock if the stock is the right multiple. And so, like, again, at these multiples, right? And I do 100. I think Eric's cash flow calculation is a little bit light, because on 100 of EBITDA, we get closer to 75 or 80 when you do, the full burden for depreciation and on maintenance capital. So he's probably being conservative with his figure. And I think you can actually look at the free cash flow that they did for the first half of the year, and then you basically just take an 80% incremental free cash flow on the incremental EBITDA, and you get to about $80 million of free cash. But that's aside from the point, right? My point is this company is generating a lot of cash. It has great reinvestment opportunities. And, look, unless you think that interest rates are going to 15% and the market's going to trade at a 5 PE, right, which I don't, right? You've got a $57 stock, and, I think it's doing, the better part of, $8 a share of free cash flow. I mean, that's pretty good, right? I mean, no multiple expansion, take 8 divided by 57 is a 14% yield that I think can grow organically, 15 to 20%. So X multiple expansion, I've got like a 35 to 40 IRR. And, then I get the capital allocation for free. So, I mean, look, again, I've been in this thing. I've read every short report, Detroit Bear, look, you guys can run around and you can talk about, heavily regulated and lobbyists, but, I've been to Expo. I've met with all the lawyers. We spent hundreds of thousands of dollars on diligence. We have lawyers. These are all locally regulated. If something ever happens at one of these clubs, I mean, look, we could fire that manager. We could kick out all the 1099 girls. I mean, look, at the end of the day, you could have, I mean, in theory, you could have one club where everyone's doing anything bad and still you'd fire everybody and then you'd redo it, right? Like at the end of the day, the company has a zero tolerance, right? Like, and from our perspective, there's no legal liability to holdings. We have a geographically diverse and a number of clubs. You got 50 clubs plus Bombshells. So like, again, I have not seen any information in any of this, whether it's some girl on Reddit saying they're doing sexual favors. I mean, I use this as an example. I was at Wynn for a bachelor party, a few weeks ago, and there were girls walking around propositioning guys at the blackjack table. Like, people can offer people things wherever they go, right? Is Steve Wynn culpable? Is he facilitating a sexual transaction? I don't think he is. And so again, like I come back to it, which is, this is a heavily regulated industry that's been around for a long time. That the company has a legal structure to prevent them from, protect them and prevent them from any tail risk liability. And, look, the company is going to continue to execute on this strategy. They are obviously the best buyer of these assets, right? Because as Eric said, right, like, if you have a big club, no one's going to be able to get financing for it, right? So you either need someone who has enough cash flow to pay you cash for it, right? Or a stock, right, that they're willing to accept. And so, I can't speak to Mr. Mooney or Spearmint Rhino, but like, my guess is that, VCGH, at $80 million is the largest strip club transaction that's probably taken place in the last 25 years. I mean, maybe Eric can chime in on that. But like, again, we are actually doing it, right? We are building an enterprise. And, since I've been invested in this company, and I don't know what numbers you're doing, but since we've been invested in the company, EBITDA has doubled on a run rate basis. And, we think the path from 100 to 500 EBITDA will be a lot faster than the path from 20 to 100.
Well, I guess I'm going to just chime in with a few points now, Mark, if that's okay.
Go for it.
Adam's repeatedly said EBITDA has grown from 1 to 100. Well, EBITDA isn't even 100 right now. In 2021, they did 60 million in adjusted EBITDA, and that's adjusted for a whole lot of things like litigation settlement, which is just the cost of doing business in the strip club world. And Adam, if you want to bridge the 60 million to 100 million, which I know is probably going to include the Trey Lowry bridge deal, that's a good thing to do. But the thing that again just frustrates me here is like, to me, as somewhat of a lack of credibility on these statements. So again, go back to the franchise deal. You announce it you've been trying to franchise for 5 years. You announced your first franchise agreement signed December 2020. Now it's 18 months later. You still don't have an open and active franchise location. And if you just look at the person who's on the press release from December 2020, it's like Nick Meady is the guy who's leading the investor group to manage the franchise. And if you just Google him, he looks like he's like, in the telecommunications industry. And Eric said there's somebody in that group who has a ton of restaurant experience. And if that's true, then we should know who it is. And I think that would add a lot of credibility to these franchise deals. Second on Bombshells, the second franchise agreement is with Eric's friend, Jerry Wustland in Alabama. I'm not even sure what you're buying if you're doing a franchise agreement in Alabama. They have 11 locations in Texas. Bombshells is maybe somewhat well known in Texas. What are you buying if you're franchising in Alabama or other states? It's not like Bombshells is well known outside of Texas. These things have huge litigation risk when you're serving tons of alcohol to patrons, because you can serve someone who drinks and drive. You can serve a minor. If you look, there's a lot of fights outside Bombshell locations in Texas. One of the district attorneys in Texas tried to shut down a Bombshell location for being a public nuisance after one of the patrons drunk drive and crashed into a cop. These are real risks when it comes to Bombshells. And again, just to me, makes me super, super skeptical that there's going to be any success franchising, even though bulls like Adam Weinstein Adam Wyden have said that Bombshells is worth more than the entire market cap today. So that's one thing. And you know, on Bombshells, there's tons of like this concept of like having attractive girls serve alcohol isn't anything new. There's Ojos Locos, there's Twin Peaks, there's Hooters. As you get bigger, that competition is going to heat up, especially outside of Texas. So again, for me, I would love to know kind of more behind like them thinking Bombshells is going to be huge and have no trouble expanding when it just like all the evidence indicates otherwise.
Okay, let me just step in here, Edwin, just quickly, and then I'll let you keep going. But I just wanted to go before I lose my train of thought. So you have an issue with the 80 of EBITDA or whatever, 100 of EBITDA versus 60. Okay,
well,
so
they did 60 last year in adjusted EBITDA.
Okay, I don't care. Like you know, I don't care adjusted, not adjusted. Like the cash is the cash. Okay, so let's just start with that. All right, I don't have my numbers in front of me. But what I can tell you is last quarter, the last reported quarter, they did $20 million of EBITDA. Okay, in a seasonally weak quarter with Omicron. Okay, I think Eric and Bradley were pretty clear that if they continue the sales rate, okay, and we'll see what happens in June. But I think that Eric, said at Sidoti or one of the conferences or the conference call, you know, in one of these open dialogues, he said that in April, you know, that they're doing better than they did in March, and May they did better than April, and that, you know, if June does well, then, you know, that, you know, comparably, they'll be on the path for 72 to 75 million in sales. And based on what they forecast, you know, for margins, barring anything changes, that would be a run rate of about $25 million of EBITDA. So, you know, I'm just taking the 20 they did last quarter in a seasonally weak quarter with Omicron, okay? And I'm saying, okay, based on what Eric has said, you know, that's happened in March, April, May, you know, and we're not June yet. But like if June turns out to be like April or May, we are going to do a revenue that is going to approximate, you know, 71 to 75, and we're going to be pretty darn tootin' close to 25 of EBITDA, if not over. Okay, so that's how I get to my 100. Okay, so let's start with that. Okay, and in 2021, there were a ton of clubs that weren't even open and were still subject to COVID. And remember, their calendar year was September 20 to September 2021. So that $60 million of EBITDA is a completely, you know, Mickey Mouse number. Right. It's, you know, you had capacity constraints, you had clubs not open, you had all these woke places in Northeast. I mean, New York wasn't open, Pittsburgh, Minnesota. So like, you know, again, you can twist the facts to make a narrative that sounds good and is a smoke and mirrors thing. But like at the end of the day, right, like they just printed 20. They told you that 20 was burdened. Right. They're telling you that if things keep up, they're going to print the 25. I guess my question to you is, and I'm not going to give you the chance to answer it yet, but my question to you is that if they do 25 in the quarter from March 31 to June 30th, you're going to tell me they're not doing 100? Because if you tell me they're not doing 100, I'm going to tell you to go jump out the window. Okay, so let's start with that. Now on the Bombshells, you know, I am totally sympathetic to the whole franchising thing, right? You know, it's a high capital cost thing, right? Franchises are generally low capital costs. So I'm going to repeat myself because I like doing that, right? You know, a Subway is $250,000. Okay. You know, trying to get somebody to build a $5 or $6 million thing, right? You encounter two things, right? One, you've got to get a big piece of land. You've got to develop it, right? You've got to get all the things. The rollout, right, of a $5 or $6 million thing is a lot harder. Then you got to get parking. I mean, you got to get the pad. I mean, look, you know, again, this is more of an Eric and a Bradley thing, you know, and maybe not even on this call, but like, you know, the planning that goes in for a Bombshells is a very, very long-term plan. Now, these guys have been able to do it faster because they know how to do it and they've developed an algorithm, right? But to a new party that needs to secure the land, right, or secure a lease to do the build out, it just takes a long time. And not only that, the universe of people that are going to go and put $5 or $6 million, you know, into a business outside of, you know, Texas is challenging. And so like, I don't even freaking like franchising. And if it were up to me, you know, we do them all company owned. So your argument that because, you know, the franchising is taking longer, that, you know, somehow the business is not working is completely specious. Go look at what the company has done in terms of same store sales and what their margin production is and what the pre-tax return on capital is for the Bombshells. Okay. Now, and then with regard to Jerry Westland, I mean, yeah, like at the end of the day, like, you know, I'd like to buy Jerry's clubs. So if we can get Jerry to have 3 Bombshells where he's making a lot of money and it allows him to, you know, have us buy his clubs, that's a great trade. But But again, I think you are overly focused on, this is kind of a smash and grab, like, oh, Jerry was a lobbyist and this guy was an AT&T cell phone thing. I read the same shit you do. Okay, so some guy who has a bunch of AT&T stores has another guy who does restaurants, and they're building one bomb, so they're going to try it out. Like, this is not like a death knell or like anything wrong about the company. The company is saying, look, we're going to try out franchising and see if it works. It's very, very low risk and we don't have to put up really any capital for it. And ultimately, all the company-owned bombshells are doing very well. So, look, they're doing 100 of EBITDA unless something changes in June 30th, right? I reserve all risk. Look, if in June, Powell takes rates to 10% and everyone hides in a bunker, then, maybe we don't do 25 of EBITDA. But as far as I can tell, I think we're going to be pretty darn close to 25 of EBITDA in the quarter, March 31st to whatever. And not only that, I would just tell you that, like, Eric is on the warpath to do more M&A. And so my argument is that, like, you can say whatever you want about this, but at the end of the day, he's shown that he can do the Lowry deal. He's shown that he can integrate it. He's shown that he can close. And I can tell you that anyone that's got a club or a group of clubs or 5 and 10 of EBITDA, they're going to be knocking on his door. And so my question to you is, if he buys 20 this year and 25 next year and 30 the following year, what are you going to say? Because at the end of the day, right, like, this is effectively an LBO, right? He just keeps buying these things, generates the cash, keeps going, and he can generate great returns with no multiple expansion. So I just don't really see the there.
On bombshells, I'll just keep hitting the same points. If there's an experienced restaurant operator who's opening a franchise, then put that name in a press release. Because right now we have Eric's friend opening one in Alabama, which frankly doesn't make much sense to me, and a guy who runs like a bunch of phone stores trying to open one in Texas with an 18-month delay since the announcement's been made. So you say it has, world-class EBIT margins, the best cash-on-cash returns possible, and I'm naturally a little skeptical, given this company has a ton of internal controls issues, turnovers in the auditor, the person leading their audit committee is their former head of investor relations, so I'm skeptical on the numbers.
Alan's not our head of the audit committee. That's not a true statement.
But he provided you investor relations services for like a decade, right?
Yes, he did. But he's just on the audit committee. He is not the chair of the audit committee. Yura Barbish is the chair of the audit committee. Who's an investment banker.
Fair enough, Eric.
Yeah, no problem. Just want to keep it real. That's all.
So Eric, you mentioned there was earlier on the call an experienced restaurant operator involved in the franchise group. Can you tell us who that is? Because
I cannot tell you. Look. Here's the problem. We're in the strip club business. Not everybody wants their name associated with the strip club business. Okay, and you can't blame them. I have no issues. I'll just tell you, we'll let the numbers speak for themselves on franchising. Look, the risk to us is zero. I say zero. It's probably not zero. It's probably between both franchisees that we have right now and all the people we're negotiating with. I'll bet we haven't spent $50,000 of company money, and we've collected $100,000 in franchise fees. Okay, so there's $0 risk to franchising for RCI. Not even $1 of risk. All of our costs are covered by the franchisees. The concept. Yes, I get a lot of flack for the franchising. Trust me, and not just from you, but from Adam, from other people as well. But there's method to the madness that will pay off over time. When we first started bombshells, you can go back and see, man, I was getting creamed. Oh, they think they're restaurateurs now. Oh, they think they know what they're going to do in the restaurant space. Oh, bombshells is going to be horrible. It's going to be a miserable failure. And yet here we are today. Bombshells saved this company during COVID because it was the first thing to reopen. Restaurants were allowed to reopen. Strip clubs were not. And it took us time to use the restaurant thesis to sue the state of Texas, to sue the city of Houston, to sue other markets to get our strip clubs open as restaurants, because we said we were restaurants with entertainment, and we put in full service menus, and we did those things, and we got open, and we recovered from COVID relatively quickly, and since we were the only things open. I mean, you want to talk about bombshells numbers? Yeah, bombshells numbers will be down from last year. There's no doubt. In my mind, bombshells numbers are going to be down from last year because we were the only thing open last year. I mean, literally the only thing open.
But Eric, that's
where
on
you
a
could go
comp
out.
score basis.
So,
You think they'll
right,
comp?
on a comp store basis. I'm talking on comp store. Yeah,
Yeah,
that's what I mean on comp store. Yeah, but at the same time, you can see through the last quarter, we've watched our margins. We've kept our labor costs in line. We've kept our food costs in line, and we've done this by going to QR menus and going to market pricing. If chicken wings, which used to be $49 a case, and have been as high as $219 a case, we raise our prices. If the price comes back down, we lower our prices back down because we want to stay very competitive in the marketplace. And if you look, one of the things, like I was watching Brinker when Brinker put out with their news, and one of the biggest things Brinker was unable to do was can keep up with that food cost and keep up with that labor cost. And it squeezed them a little bit, squeezed their margins.
Eric, Adam, I have a question for you guys. In an optimistic scenario, because a lot has been made of bombshells, and a lot of the retail investors in the stock are really excited by its potential. How many franchise and company-owned stores do you think you'll have 5 years from now, 10 years from now? Okay, 5 years from now, what do you think about?
Let me answer that question quickly. I think Eric is a very methodical investor, and he's been at this for 27 years. So I think the short answer is it'll have as many as the cash on cash returns and the ROIC on a risk adjusted basis is sustained. I mean, I think I was just having a conversation with Eric this morning, and he was saying, well, the bombshells are going to get more expensive to build, I think, because of inflation. But he said, well, but the most recent ones we've done, the last 4 have been larger and have been doing better margins. And so I think, I think Eric is a learner, and he's dynamic, and he takes the data as it comes. And I think, if anything, he's shown you that he did it methodically. He did a couple first. He had to close one. He's basically, I don't know, Eric would have to correct you. I think he's been at it since 13 maybe, but he's basically built 11, right, in the better part of 9 years. Right now, some of that is getting the formula right, and some of that is just the ability to deploy capital against the other opportunities that he has. But I think, look, even if it only gets to 30 or 40 or 50, I think it's a success. I think it's a success today, right? I mean, if you've deployed $55 million of capital and you've got the better part of 18 to 20 of EBIT, right? That's been a great investment. And so look, I think what Eric is going to continue to do is he's going to consider each capital allocation decision that he has, right? Whether that be buying back shares and buying back in the company that he has today, or buying another gentleman's club, or building another bombshells. And that's what's so great about this investment is you have a CEO who's basically come to you and said he's made a lot of mistakes, right? Since 2016, he's employed this capital allocation strategy consistently, and it's not lost on everyone that's when the business has really started to improve. And so, look, I think a lot of the things that you bring up are legacy, and that they've been a long time ago. But at the end of the day, I think Eric will continue to invest the capital judiciously, and I don't think you can ascribe to kind of a formula and say, okay, we're going to have 6 a year. If he has 6 a year and they go amazing, then they'll go to 10.
But Adam, I'm sorry to cut you off. You can't have 6 a year because your lender agreement says you're only permitted to open 3 a year. And I just tweeted out a link to that lender agreement.
Yeah, I just saw the link. That's without permission. All I have to do is ask.
Okay, but you're
and that's with debt. Keep in mind that's also with debt. In other words, I can't take on more than 3 new loans for bombshells a year. That's what that agreement is. And all I have to do is ask. Trust me, my bank will do anything I want right now. Our debt to equity ratio, our debt to EBITDA ratio is very, very low. Our debt coverage is well over the 1.4 times minimum. In fact, I have to check with Bradley, but I think we're getting close to 3 times debt coverage. So I mean, there's no issues with building bombshells. You can bring it up, but there's no issues with it.
But if you guys really wanted to build 6 a year, if you guys want to get to 40 or 50 locations in 5 years, if the economics are truly as beautiful as it is, why is there even like a lender restriction on only 3 a year? It just everywhere I look with bombshells, respectfully, it just doesn't make sense to me.
Other loan that was carried over from our original loan. We did a refi. That was just carried over from the original loan when we weren't expanding as quickly. If you go back to the original loan in 2017, that's the exact language from 2017.
Okay, Edwin, let me just jump in here for a second. Like, I know you're super focused on bombshells, and I think, bombshells is an interesting asset, and, maybe down the line it makes sense to sell it to a sponsor or maybe merge it with Ojos Locos or Twin Peaks or any of these other things. But as of right now, Eric is building them thoughtfully and adhering to his capital allocation policy. I would just come back to you and say that, like, look, Eric did the Troy Lowry deal, the VCGH. It's been on his mind for a long time. As my great grandfather used to say, chance favors the prepared mind. Eric had been working on this thing for a long time. He was ready to strike, and he did. Now, that transaction alone, I think, will prove out to be very, very fruitful and will be $20 million of EBITDA, right? That is basically the same amount of EBITDA that Bombshells does today. So if Eric continues to find transactions like that, the nightclub segment, which you actually say has value, will continue to grow at, if he can do $20 million of EBITDA a year, that's more than all of what Bombshells is doing right now, or about the same, right? Now, if he can find clubs that are 5 or 10 million, maybe he does $30 million of EBITDA through M&A. So again, I think what Eric is doing is he's looking at his capital allocation policy, and you look at the unlevered returns, right? Like, just do it on unlevered. Go to the decks. You look at, and Eric and Bradley will share the information with you, right? They are averaging roughly 30% unlevered cash on cash returns on Bombshells. Average. Okay. Now, in some cases, it's better, right? So if I told you that you could go and do an unlevered deal, that's the same thing as buying a nightclub at 3 times EBIT. If he can continue to do that, right, he's going to go and invest in Bombshells at 3 times EBIT, right? If he can go and buy a nightclub at 4 or 5 times and get that lower, he'll do that. If the stock trades really, really low relative to his other things, he'll buy back that stock. I mean, I think, look, you have 3 different levers to value creation here, and they're all active and they're all available. I mean, and so again, I think your whole Bombshells boogeyman thing, kind of presumes that he's going to go and throw really good money after bad on it, and he's shown you nothing of the sort.
Yeah, I mean, look, in 2016, we developed our capital allocation strategy. And that's when we started taking the free cash flow. And that's why we look at free cash flow. Everybody keeps talking about EBITDA, adjusted EBITDA, all that. To be honest with you, I don't pay attention to any of that stuff other than when we're making acquisitions. That's only when we're buying somebody else's acquisition, we use an adjusted EBITDA multiple to add back their season tickets to the game, their insurance, and their kids' cars that they pay for through their company, stuff like that. We take that stuff out and give them add backs for it. But for us, it's free cash flow per share. And it's, we did 33.8 million. Our Kaylor rate since 2016 is about 20%, a little over 20%. And that's what we're really shooting for, is to continue to grow free cash flow per share. In 2016, we had 10.8 million shares fully diluted. Today, we have about 9.4 and change as of the last quarter.
And that includes 500,000
that
you gave to Troy.
So,
it's really 8.
Right.
It's really 8-9 because you gave 500 to Troy accretively.
Right. We used our stock to increase free cash flow per share, not only on those shares, but on the rest of the shares of the company as well. And you're going to see all that as we start rolling out these next quarters. The biggest problem we have is we have not had a 3-month period where we have not been affected by either COVID restrictions, COVID close downs, COVID itself. I mean, we lost 6 weeks, January and February, actually last week of December, right from Christmas through the second week of February, we were affected in different markets for typically 2 to 3 weeks at a time. At one point at Tootsie's, we were having barbacks and managers bartend because our entire bartending staff was out with COVID. So, I mean, it was very rough in January, especially. But since then, we've recovered. We're running 100% everywhere. And you're going to see those results in August when the numbers come out. You're going to see the first time that we've had all of our operations. We've told you from day one on the major acquisition that we had some management issues. Typically, when we take over a company or take over a club, we retain 80% of their staff. Only about 20% of the staff turns. In this acquisition, we turned almost 80% of the staff. And it wasn't 1 or 2 clubs, it was 11. So it was a major overhaul at a time when nobody wanted to work. Everybody was talking about labor shortages, how hard it is to hire employees. And yet our team not only managed to bring those clubs back, and I said, look, we won't turn those clubs back to their original numbers before May of this year. So last month would have been the first month, but actually our team turned those clubs in March. And I think we put out that they were 95% of 2019 numbers in March, and EBITDA was actually increasing because we were able to cut so much top heavy overhead. from those deals. So we'll continue to follow our capital allocation strategy. That's what we've always done. We have a lot of great opportunities out there in acquisitions. We're going to continue the acquisitions. We're still looking for Bombshells locations. We have 2 that we've closed on that are starting construction very soon. We have a 3rd under contract. We have a franchisee that's going to open in 12 days. So, hey, in 12 days they don't open, you can call me and say, what's that? I get it. But once again, I can't control franchisees. We tried to guide them to certain things. We told them about long lead times on certain equipment, and they waited. They thought they had it under control. And of course, as franchisees, I can't make them spend their money when they should. I can only come back to them and say, please, next time, listen. We now you understand why we told you to do this. And so they're going to learn, and their process is going to learn. And they're already looking for their second location. So I suspect that they'll get this first one open pretty quickly, and then start on their second location relatively quickly. They're very aggressive guys. They're learning the restaurant business from a building standpoint. They've always done, like, their restaurant guy does, very small, in shopping center type restaurants, not big standalone restaurants like Bombshells is. But they do have they have the experience of managing the labor. That's the main thing I was concerned about. They have the management of, or the experience of managing food costs. So those are the kind of things that attract us, and that's why we chose them as our first franchisee. I turned down 15 franchisees or more in the last 5 years because I didn't want our first franchisee to fail. I don't want any opportunity or any chance that first franchisee will fail, because then you're done, right? Who wants to franchise at what our franchises cost? I can't have a failure, especially early.
So Eric, I hear that, and maybe we should move on beyond Bombshells soon, because there's a lot more to Rick's. But I hear that you don't want your first franchisee to fail, and now your second franchisee is opening locations. Your friend opening locations in Alabama, and that's, I guess, just a little bit of a head scratcher to me, because it's obviously a lot tougher to open up franchises in other states where
have you been to Huntsville, Alabama?
What?
Have you been to Huntsville, Alabama?
I've been to Alabama. I've not been to Huntsville.
You got to go to Huntsville. It's Rocket City. It was just voted the #1 place to live in America, right? I mean, it's got more defense contractors than I don't even know where defense contractors operate at, but I know it's Huntsville, Alabama.
But what does that have to do with Bombshells and your name recognition and your brand and what you provide as a franchise?
Edwin, let's relax a sec.
Yeah.
First off, Birmingham, Alabama, actually, most PhDs per capita of anywhere in America. We've spent 51 minutes now talking about Bombshells. That's only a few locations. 49 clubs are the rest of the business. So why don't we transition into that and the other points that you brought up in your report?
Now, so.
Amazing. There we go.
Can I ask a question for Eric and Adam on the clubs? No more Bombshells, but on the clubs. Sure. And Eric, you obviously know this space really well, and you seem to be a savvy operator here. If I go through your past acquisitions, it seems like most are done between 3 and 5x EBITDA. Scarlett's was like 4x EBITDA. Your Trey Lowry deal, which was really big, was closer to 5x, I believe. Your ones a little before that, like in Pittsburgh and Chicago, seemed to be like 3.5x EBITDA. So you're acquiring these clubs for like 3.5 to 4 to 5x EBITDA. What should they trade for within Rick's? Like how should the market value them? Because it seems like you guys are getting a large premium above what you're acquiring them for right now.
I don't understand where you see we're getting a large premium. I guess because you're looking at the historic run rates through COVID. The only time in the history of this company we've had what I would consider an extremely high multiple rate was in 2008. Into 2007, early 2008, when we first bought Tootsie's, and the stock ran to $28 or something like that. And our revenues back then, I think, were $30 million, maybe $40 million. Wasn't much. That's the only time. Our market cap is higher than Playboy. So that gives you an idea of how I think the stock got way ahead of itself back then. And we used that equity. We sold stock for $25 a share in June of 2008. We did 11 acquisitions in 2008. Almost every one of them had an equity component. If you want to go back and look at those, you'll also see that in 2009, when the market crashed, we bought back all those shares we issued out at an average cost of about $3 and change. because we took advantage of a capital allocation strategy we weren't even aware of at the time. It took us a long time to. But yeah, I think that typically, you know, are we going to trade at a 17 restaurant multiple? Probably not. And that's why that's why I like the franchising. Just run back, because the franchising will give us a higher multiple if we ever decide to sell the Bombshells franchise or the Bombshells concept to someone else, private equity, other restaurant, public companies, whatever. If that chain ever get it to a point where it's critical mass and somebody else wants it, they want that cash flow, they're going to value it higher. It'll sell way over. I think Bombshells will always be worth more than the company as a whole on a multiple basis. But I think that we're unfairly treated sometimes, where we trade less.
Let me just step in for a second, Eric. I didn't mean to interrupt you, but look, I think the question you got to ask yourself is that what is the multiple that you are comfortable owning the asset without having to resell it? And I think that's the real answer, right? Like, at 8, maybe the number's 8 times EBITDA, maybe it's 7.5, maybe it's 10. But the question you got to ask yourself is that you're saying, well, what multiple should it trade at, right? Well, let's start with this, right? So you made a point.
Adam, why would it be 10 if you're buying them for 3?
Okay, so let's start with that for a second. First of all, are you telling me that 50 clubs, geographically diverse, right, that have the benefit of a point of sale system, an ERP, and all of these corporate things, right? Just take a step back for a minute, right? How much EBITDA are you buying at 3 times? Are you buying $1 million of EBITDA? Because I can promise you're not buying $5 million of EBITDA at 3 times. Chances are you're buying $5 million of EBITDA at 4.5 to 5 times. If you're paying 5 times, it means that it's really, really well run. If you're paying 4.5, it means that there's some fixing that needs to take place, right? So you're not buying. I do not believe you're buying a club with its real estate at 3 times EBITDA if it's $1 million of EBITDA. And I know that because I'm seeing the transactions that are taking place in this market today, right? And so, I kind of know where that is. And so the question I have back to you, right, is take a step back. Take my 100 million of EBITDA and assume that they're investing. I don't know what the corporate allocation is. I'm sure it's somewhere between 10 and 20 million, right? And so the question is, are you telling me that a business, right, is worth like a small $3 million EBITDA strip club is worth less than 50 of them geographically diverse across Texas and Florida and New York with a huge corporate burden against it? No freaking way, right? Like, that's the whole point. And so, like, if you're basically saying that, capital markets, ceases to exist, right? Because I can tell you that many, many great companies have been formed through roll up, whether it was First Service, whether it was, God knows what. I mean, I'm blanking here, but there are lots of great companies, right, that acquire assets. Watsco, Site One.
Adam, let me cut you off for just a second. Let's put it this way: when we buy at 3 to 5 times, we're buying small single club operators that have much higher regulatory risk than a company like RCI that has 50 plus locations around the country. So our regulatory risk is much less on our total cash flow than, say, a specific individual club that we buy at 3 times. So we should definitely get some type of premium. You guys will have to decide what that premium is. I'm not a stock expert. I will admit that. I'm an expert at running my clubs. I'm an expert at building our businesses and allocating our free cash flow. Over the last few years, gotten even better at it. But as far as, you're going to have to be the one to decide what is that risk. If I can buy it at 5 times, and it's a single club or even multiple clubs and we put it into a conglomerate that has spread that risk over multiple locations. This is how I got the bank to loan us money. Okay, no bank would ever loan us money. And the biggest thing every time I went to the bank, I met with the bank presidents and stuff. And so I finally got a bank president. I said, look, you do a lot of shopping malls, because they're a big shopping mall lender. And I said, you do a lot of shopping malls, right? Stop looking at me as a single tenant business. This is not a single tenant business. This is a giant shopping mall. You're going to loan on 43 properties. I got a mall that's got 43 tenants. And if my mall gets hit by a fire, you lose 1 tenant. If my mall gets hit by a hurricane, you lose 1 tenant. Maybe 2 if it's in one of our market. We have two units. But I said, if your mall gets hit, you lose your entire mall. All your tenants are gone. And I said, if you look at us as a shopping mall of strip clubs, so we have a bunch of strip clubs, but our properties are just a giant shopping mall, then your risk is so much less loaning me money than it is loaning that money to the shopping mall. And we closed an $87 million loan 6 months later after that meeting. Our first big refinance. And so you got to think of it, the same way. Yes, if you bought one strip club, yes, you have a lot of risk or different risk. But if you buy RCI, who has 50 clubs in multiple markets, your risk of losing your entire investment is much, much less. So what is the premium? You tell me. And Edwin, I don't know what the premium should be. That's what you guys should be, working on coming up with. What multiple should I trade at above what I'm purchasing at by limiting risk? The other thing I do is get national buying power, stronger management, best practices, national insurance coverage. I lower the costs to operate your individual club by bringing in all of the buying power of the entire company of RCI. So we add value there as well.
Food purchasing, right? It's not just managerial skill. It's food purchasing. It's point of sale. It's accounting. It's back office. I mean, yeah, there's a lot of value. I mean, it's basically what you're saying is you're invalidating roll-up math. And, whether it's Danaher, whether it was O'Reilly, there have been many, many, many great roll-ups, right? I mean, to basically say that a collection of assets that is 100 times larger than whatever you're buying is not worth a premium is basically invalidating, capital markets and finance, right?
Adam, I'm not saying that it's not worth a premium. I'm saying if you're going to buy it for 3 to 5 and then you throw out that it should trade at 10, that kind of doesn't make sense to me. That means that's too excessive of a premium.
Really? Because I can tell you that Watsco and many other great Fastenal, there are a lot of really great distribution assets that have traded at 20 times EBITDA acquiring 5. So for you to say that 10 is excessive, I think basically shows your historical experience, studying successful roll-ups, because, many of these roll-ups have traded 15, 18, 20 times. Waste Connections, someone just reminded me about Waste Connections, Casella Waste. I mean, many, I know Mark, thinks waste management's bad. I mean, yeah, but there've been a lot of successful roll-ups in the waste space that trade at a premium, So again, if you're telling me that it's like, against, the religion of capital markets that you can buy something at 3 to 5 times and trade at 15, all you need to do is look back at history. Let's go look at the history.
Adam, I'm not saying no roll-ups can trade above 10 times EV to EBITDA. What I'm saying is that strip clubs have huge risks that are reflected in reasons why they should trade.
Well, let me take that on.
Adam, let me finish.
Hold on.
All right, guys. Yeah. One person at a time.
I want
me. Yeah, let Edwin finish, Adam. Let him finish, then go. Let Edwin finish.
Thank you, Eric. To me, when I think of strip clubs, you look at markets like Fort Lauderdale, where there were a bunch of strip clubs. The local government had a change in sentiment, and my understanding is they were all driven out. Now, that's unlikely to happen in Miami or New York, but it's still a possibility that you could have that happen in other rich markets. Or the poll tax, where in Texas, I believe now, every patron that comes in the door, Rick needs to pay a $5 tax to the government. And I think that's taken added back into adjusted EBITDA, even though it's a really real cost. And there's
it's not added back in. It is expensed out.
It's probably
tax on our taxes.
Yeah, it's probably a revenue tax. But here's my point, and this is one that's really kind of getting under my skin, which is this boogeyman regulatory thing. Okay,
hold on.
Let me cover this, because we spent a lot of time on this, and I really want to get this point across. Okay, so we've covered bombshells. So now we get to the nightclubs. Oh my God, they bring me into the room. The girl offers me a blowjob. They do this, they do that, and and the whole thing gets shut down. Because that's basically what you're saying. You're saying, oh, they get really drunk and they get pulled over, or the DA gets mad, or some Elizabeth Warren shows up and as the mayor of Fort Lauderdale and says they want to shut it down, right? That's what you're saying. Well, how do you prove God does or doesn't exist? Because that's what you want to do. You want to yell fire in a crowded movie theater, and you want to say, okay. Well, let me tell you something. Strip clubs have been around a long time, okay? I'm sure if you looked at the statistical data of the 2,000 clubs, you can probably figure out how many of them were closed. And then I encourage you to figure out how many of them were closed that actually generated any EBITDA. I know from personal experience, because my father wants his hand in everyone's pocket, including my own, that when you're making a lot of revenue money, it's not easy to shut it down. So when you got an establishment like Tootsie's doing 40 million of revenue, right, and paying a huge patron tax, my guess is the city of Fort Lauderdale or Miami Gardens doesn't want to shut it down so easily. So let me just start with the facts, okay? Why don't you go and pool all 2,000 clubs and figure out how many of them were shut down, and then cross-reference that information as to how much revenue they were generating. It's not very easy, okay, to shut down an organization that's giving you a lot of money. But let me take it one step further, right? Because you don't like to understand facts or listen to facts. I told you, and I'll tell you again. Okay, RCI Management is a third-party management group that manages the clubs. Okay, they manage them. They manage the clubs on the behalf of RCI Holdings. RCI Holdings owns the clubs. Okay, they own the real estate underneath them. If anything happens, it's going to be up to RCI Management. And in the case of RCI Management, right, RCI Management hires girls that are independent contractors. So this is not an employee thing. The girls are 1099s.
Actually, the girls work for the individual subsidiaries, not RCI Management.
Exactly.
Only management works for management. Everyone else works for the individual subsidiary that operates and owns the actual nightclub in operation. RCI Holdings is the land company that owns the real estate. RCI Management is the management company that manages those things. And RCI Hospitality Holdings is strictly a holding company. It has 3 employees and it owns stock in other companies. And that's the only purpose it serves, other than being the public company vehicle.
Yep.
So, and RCI Management Services also does all of our SOX compliance and, does our financial statements, consolidated financials as required by the IRS and the SEC.
Right. So to say that there's some sort of boogeyman thing where you're going to shut the whole thing down, like, I don't buy it. Right. So, look, we live in a world where there's payday lending. Mark and I talked about timeshares. I actually happen to agree that, trying to shove a timeshare down a 75-year-old woman, with 20% interest rates isn't really the right thing. It's expensive and they don't really need it. Now, if you use your timeshare, it can be valuable and you can make the math work. But in general, there are many industries that are far more predatory. Whether it's payday lending, whether it's selling a timeshare at a 20% interest rate, whether it's Herbalife, with multi-level marketing, selling them, protein powder, protein powder for 30, that costs 30 cents and charging $3, right? There's a lot to, there's a lot to unpack here. So look, at the end of the day, there are many industries that are super predatory. Look, my sister-in-law works for the DA in Detroit. I've had conversations with her. If properly executed in governance, I argue that this is even female empowerment and ESG. I mean, Eric married a girl, she turned into an estate lawyer. I mean, I've heard stuff all over the internet of girls, they go to veterinary school, they say they send their kids to, private school. I mean, this is an opportunity for people to make money, have a flexible work schedule, and go and improve their lot in life. And so this whole sex favor thing and whatever, it's just a boogeyman thesis. You're 24 years old and you want to say, it's going to get shut down. Well, let me ask you something. How many strip clubs have actually been shut down, and tell me what the EBITDA is? Because look, you can say whatever you want, but this ain't freaking Valiant, right? There's no Hillary Clinton coming in here and saying, hey, you're charging too much and you shut the whole thing down. Okay. It just ain't happening. It ain't happening because this creates value for all of the supply chain, right? It creates value for the independent contractors. It creates value for holdings and shareholders. And so, I know it's really exciting for you to be like, oh my God, I'm short a strip club company. But let me tell you something. People have been trying to short this company for years, and all he does is generate cash and grows the cash flow. So we can just add you to the list of everybody short the thing and been wrong. I'm happy to do that.
Look, Adam, I'm not saying it seems like you're narrowing the only risk to strip clubs as a police thing coming in and arresting people for providing extras and shutting a strip club down. And, there's some remote risk of that, I think, at every location, but there's a lot of other risk. And again, Eric would know this a lot better than me, the regulatory environment. But my understanding is there's time, place, and manner. TPM that's the main restrictions you have on strip clubs. And if a local government doesn't really want strip clubs around, you might just limit alcohol sales until up to 2 p.m. or 3 p.m. And those things can change and have an enormous effect on the profitability of a strip club. And my understanding is that's exactly what happened in Fort Lauderdale, and they drove out all the strip clubs.
Edwin, you are very wise. You have done a lot of homework. I'll give you credit. Yes, time, place, and manner. Let's talk about time, place, and manner. That is basically Renton. And then you've got Alameda Books, you've got Barnes, you've got a lot of Supreme Court cases that basically give First Amendment protections to entertainers and strip clubs. Now, what you've got to understand is the tide has been slowly changing, and the time, place, and manner doctrine is changing. And so now you have direct scrutiny and indirect scrutiny that you need to look into a little bit. And you need to look at a couple of Fifth Circuit opinions that have come out recently that are starting to change thing and overturning massive amounts of what everybody thinks is set law. And it's going to be very interesting over the next few years how this develops through the courts. But the real risk is no matter what they do, our business survives in some form. Even in California, you cannot touch a girl in a state of nudity, right? She has to dance with her clothes on. If she gives you a table dance or lap dance, she has to have her clothes on. There's still strip clubs in California. There's clubs in this country you can't even have alcohol in the building if there's a state of nudity, but they become full nude. They call them juice bars, and yet the business continues. I call it the roast beef bologna theory. If I'm eating roast beef every day and all of a sudden you start feeding me bologna, I'm going to start bitching about the bologna. But after about 6 or 8 months of eating bologna, and that's all I've had, I don't know the difference between bologna and roast beef anymore. And so when cities come in and make changes to our method of operation and they take us from roast beef to bologna, it's a problem for about 6 to 8 months. Our sales go down a little bit, but eventually we retrain customers, we retrain girls, and everybody gets used to the new, what I call bologna, and the new bologna becomes roast beef. Now, if you have a place where, and this is where we really look for the kind of clubs where we think we can go in and everybody's been eating bologna and we can change it into roast beef, because nobody complains when you take their bologna away and give them roast beef. Well, I take that back. There's always some people that complain about all change, but mainly you get the idea. And so, the idea of just being able to, so what they have to do is independent studies. And that's what all these cities have messed up on. Because in the old days, when these studies were done in the 1970s and 1980s, when all the strip clubs were in these really bad areas and, biker bars and regular, really, really rough areas where basically all the strip clubs operated, excuse me. And so they come and do a study and they say, oh, there's all this crime in this area. And that was true back then. But nowadays, all the ordinances have changed. All your strip clubs have to be 1,000 feet apart. They have to be 1,000 feet from schools, from churches. I mean, basically, they're in areas where the crime is much, much lower. And because they're not all congregated together, the crime is lower. And so when they go and do these studies today, the studies don't back their thesis. And so it's hard to get a court to change the time, place, and manner of a business when they can't directly correlate the crime to the business. And most strip clubs, guys don't come to our places looking to fight. They go to country western bars looking to fight. They might go out to regular nightclubs and get drunk and get in a fight. But they come to our place for entertainment. They come to be entertained. They don't have this. It's not the same business as it was 30 years ago. And so these studies don't work as well anymore. And plus, a lot of our clubs, what we look for are grandfathered locations where they've already been through all of this. They've already fought these legal battles, and there's court orders that have saved a specific location. Like they try to close all the clubs down, and the court says, oh, you got to basically have 5% of your area space zoning for adult entertainment to provide for the people who want adult entertainment. And so we try to go into places like New York City, where all 3 of our locations are part of the Giuliani federal lawsuit settlement, and they're all covered by that settlement. And so basically it's very difficult for the city to go in and change our method of operations without violating the court order. And so New York is what it is. You'll never have clubs over 10,000 square feet, but at the same time, we can operate there, forever. So, but I'm very impressed with your knowledge of that. There's not a lot of people understand the time, place, and manner restrictions that the courts put in place several years ago.
Well,
Hey, Edwin, one second. I just want to say that I'm going to add Mark Cahodes in. And so
let's get Mark in there. He wants to say something.
So Mark, feel free to make a statement. I know you're a short seller. Do you have a position shorting Rick?
I don't think he heard you. I don't think he was actually speaking when you asked the question.
Yeah.
Hey, Mark,
Do you guys hear me?
We can't.
Yeah, we hear you, Mark.
Well, first of all, I have no position in this whatsoever. And I have great respect for Edwin, who I've known since he's had 6 followers, and Adam, who sometimes I agree with or disagree with, but that's okay. And what I really want to say is that this forum and the idea of putting this together is simply outstanding. It is totally okay for people to agree, and it's totally okay for people to disagree. But the importance is that people listening get to hear the bull story, they get to hear the bear story. Everyone's done their work here, and everyone can come to their own conclusion. And there's a lack of this discourse that goes on in the markets today. And I think you guys have done an absolute outstanding job of giving the listeners the full shake of this. Everyone can make up their own mind. Everyone can buy the stock, sell the stock, short the stock. I think the CEO of Rick's has done an outstanding job of articulating his point of view. I think Edwin's done a great job, and I think Adam's done a great job. And I have no dog in the fight, but I think this is just an outstanding spaces call, and there should be more of this. And it should be the gold standard of what people aim for. So I just want to say well done by all parties. Edwin, Adam, Rick's, Mark, very well done. And I'm very impressed by everybody. That's all.
Thank you so much, Mark. We appreciate that. I wanted to just point out Benzinga is a co-host here. Aaron, do you want to say anything before we let Edwin jump back
Did
in?
Edwin want to respond? I think Eric was talking, and then
We'll
Adam.
we'll let Edwin respond in a second. I just want to reiterate Mark's point. I mean, we're in a new age of investing in finance, and Benzinga, we pride ourselves on being this place that retail investors can go to for information like this. And, shout out to Mark, shout out to Liquidity and everyone participating in this, because like Mark said, I think it's a beautiful thing being able to hear the bull case, the bear case, and everyone based on that can make their decisions, because there's too much content out there that's just, go buy this or go buy that. So it's great to get both sides here. And yeah, give us a follow, give Benzinga a follow, give me a follow. If you guys are in the industry, if you're in finance and you guys want to hop on our show, you want to do some coverage, let us know. DMs are open.
Thanks so much, Aaron. Now, Edwin, you're back up after that brief intermission.
Well, thank you. And Eric gave a really good overview of the strip club regulations. And, that Eric is going to go know 100 times more than me when it comes to strip club regulations. I guess the main point I was trying to make is it's not just a boogeyman, police are going to come in and shut it down. There's other risks. And Eric seems to be saying that those can be managed. I just want to point that out. Now here's kind of a question for Eric and Adam if he wants. And this is more of like a genuine question here. But 10 years ago, 2012, I think Rick's adjusted EBITDA was 30 million. Then you go to today, and it's 60 million last year. Okay, so it's doubled over the last 10 years. You guys might say it's tripled if you want to use an optimistic run rate today, but it's doubled or tripled, and the stock has gone up 5x over the last 10 years. So to me, it seems like the market's not just giving you credit for the growth. It's giving you a lot of credit, and maybe a skeptic would say too much credit, an excessive amount of credit for the growth. So given that, that your EBITDA multiple has gone up a lot over the last 10 years, why do you think it's so undervalued today?
Sure. Well, I mean, I don't know what the stock price was in 2012. I'd have to go look it up. But I guarantee it was probably about 3 to 5 times because that's basically where we've historically, continued to trade. So, our market cap in 2012 was probably not much different on a multiple basis than it is today because we've had so much growth. And what is 5x? What is 5x?
Hold on, Eric. Let me just jump in here for a second because I don't
Sure.
know where he's getting the 30, but I see fiscal year 2012 of $24.3 million of EBITDA, okay? And I see an enterprise value of $140 million, okay? That's total debt of 63.5, a market capitalization of 80 million. So thankfully, thanks to my good friend Michael Bloomberg, who actually
You're faster than me.
I can pull it up right now. So at the end of fiscal 2012, you had $140 million enterprise value. right? Now you had some real estate in there, and that was this $80 million cap, $63.5 million of debt. That's $140 million enterprise value. So I take 140 divided by 24.3. That's about 6 times EBITDA. So I'd like to just kind of take the mic away from Edwin, because he likes to kind of make up numbers. We were trading about 6 times EBITDA in 2012. I think we're probably trading right about 6 times EBITDA right now. So I think the stock is probably up as a function of cash that was generated, share repurchase, and the growth of EBITDA from 24 million to 100. Because on 100 million of EBITDA, I'm right there, front and center, 5.5 times. And that's exactly why I'm here, because I think Bombshells is higher than 5.5 times, and I think the nightclub business is higher than 5.5 times.
All right, guys, the Twitter space is still going on. If you guys want to check it out, you can join on Twitter. I'll be following. I'm still in the space on my phone in case I get called up for any more co-hosting duties. But I do see Nick here hanging out with us. We've got Nic Chahine here. So if we want to do some options trading, let's go ahead and bring Nick on. Nick, how's it going?
Pretty good. I just have a deep radio voice today because of whatever I've got going on.
Well, you sound great. It might just be I had some allergies going on today too. I don't know what it is, but yeah. So if you were wondering what was going on, we were doing a live bull versus bear debate on Twitter Spaces. So Edwin Dorsey, who we've had on the show before, put out a short report on ticker RICK, RICK, which is a company that owns and operates strip clubs throughout the country. And the CEO of RICK's is now on this Twitter Space, as well as the biggest investor. It's getting very heated.
Wow.
But Nick, I'm gonna go ahead, and if you want to get your screen pulled up, do you mind just running through some tickers, some things you're watching real quick? Because I'm still got
Sure.
monitoring this space as well.
Yeah, no problem. I'll share my screen. I think I can. Where is it?
I don't. I'll let you
Okay,
know when
there
I'm
we
seeing
go.
it. I'm not seeing it yet.
Okay.
Yeah, they're getting.
I want to share the right screen. There we go. Allow.
And then I'll pull up some tickers from the chat that people are looking at. But if you just want to roll through some of your trades or any charts that you've been looking at.
Okay, so what we're doing today is I have been working with the SPY and the SPX from the open. So I have right now, I'm sharing the screen with 280 people, 281 to be exact. And when the market opened down, we sold risk. We sold put spreads at the open, SPX and SPY. And then and IWM, whoever wanted to do that. And then when we rallied back, we sold credit call spread. And now they're both dead in our favor. So basically, we sold a lottery ticket for somebody who's super bearish and somebody who's super bullish, and they both lost. And we did that yesterday, and we did that the day before yesterday. So that's the easy money right now. And like right now, I'm watching. This is the S&P. We kind of saw this coming. I warned about the bounce once they lost this little guy there, that the bounce would fade. And if they lose where they bounce from, they will get to here. Of course, they overdid it. That was surprising. And now I said buy the dip. Not just me. There are a couple of people that know their charts as well in my room. So we all had consensus that we're falling into a prior base. We should try some calls with a tight stop, and we did. And they paid 10, 12% for somebody who jumped in and out. And they did jump out. So, but here's the important part. So this is a moving target. So if you're trading actively today, last I checked about 10 minutes ago, I'm reading the open interest and the volume in the options for expiration today. So the idea is to track it and see if we can trade it last minute. So if this was the case with 10, 20 minutes to go and the price falls to here, we might see a little burst to get back into the box. So that has worked very well before. And those trades are usually very cheap, pennies, and then they turn into dollars. But the meat and potatoes is basically trying to range the trade action intraday. Yesterday, I sent out a video which lays out, I think, what is going to happen for the next few days. I think we should be edgy going into the weekend. Maybe tomorrow should be a tough day. Maybe we pop Friday morning because the CPI is not super bad. I'm speculating. I don't know. The point is, if we pop before the weekend, I want to buy a put spread because I think we will drop into Wednesday and then rally after the Fed. Regardless of what they say, I think we rally. So we'll see what happens. Goldman Sachs and company are scaring everybody into thinking that next week can be a disaster because it is massive as far as options expiration. But I went to Google that statement, and I Googled something like options expiration 3 trillion. I put 3 and like 3 or 4 other headlines came out that were in the past with the same wording. So we've seen this movie before. I'm cautious. That's why I bought the put spread. I said I would buy the put spread. I'm cautious because I'm selling risk below and leaving room for error. For example, if today we're looking at Intel falling for whatever reason. Did it have a headline? I'm not sure. Yeah, so it's falling out of bed. I think AMD is also falling, but 5% seems like a big deal. Falling into a very sharp bounce level, and it hasn't been in the 30s in a long time. I think 2017, maybe even 2016. If I go to a weekly, you'll see. This is a weekly chart. So this was the last time it was in the 30s. So 2017. So what do? If I sell a put spread here, again with the boring put spreads, but that's how you can do it when the markets are uncommitted. I sell a put spread and I won't even defend it. What does that mean? If price goes to it and I get in trouble, I wouldn't defend the spread. What I would do is I would say, okay, give me shares at 37 or 38, and I will sell the protective put for a profit. Then my break-even point would be like 35. So if the worst case scenario on that trade, I either make money out of thin air or I own Intel at 35, I think I can risk Intel at 35. So that's what I would do with that. So there's not much to be done. A couple of people asked me if they could short Alibaba. I said, why would you want to do that? Somebody wanted to short, actually 3 people wanted to trade Tesla. So I came up with a couple of ideas there to range the action in Tesla because it is so hard to pin it. So I said, don't buy it here. This gap is too tough, I think. Short-term resistance, sure enough, it played out. I think I have a picture here. Okay, so there we go. So if I do this, this was the Tesla chart I helped people with this morning. So they wanted to buy calls or buy puts. I said, why don't you sell both? Sell a bullish position up here, sell a bearish position down here, and if nothing happens, then you win. That was for this week if somebody is really active, or this is for next week. So how do we win? If Tesla stays below this, which is 840, and above this, which is 640, they win. How much? 25% on the risk. So these are the kind of things we do when you don't know what's going on. The VIX is whatever it is, 29, 24, where is it? It's well above its average, right? So the market makers don't know where it's going to go. That's why the VIX is high. So the VIX reflects the edginess of the market makers. So if the market makers who control everything to a degree, they're pricing everything expensive because they're not sure which way it's going to go and they just want to make their money. So it's pretty cocky of us to say we know where it's going. Sometimes we do short term. Like I know if this broke out, it goes to here or thereabouts, and it happened. But overnight, like who knew that Twitter would do this today? Right? Today, I was watching it and an alert came up for this, whatever this thing is. And there are people that still chase it like that. It's unbelievable. So anyway, I am long Twitter, but it's an arbitrage position. So it either happens, the buyout, or it doesn't. And it wasn't that expensive. It was like 45 cents. So that's the kind of trade you do with Twitter. So this is what we're doing today. I don't know what Rick is. You mentioned it. Is it Rick, you said? I think I'm alone here. Okay, no problem. So here's what we'll do. Can I see your comments? That'd be great. Hey, Robert. I'm reading the comments, catching up. How does this scroll down? Okay. So if anybody wants to review a ticker, let me know. Happy Muhammad. Thanks for that. Disney. Okay. Vivix. Really? Okay. No, we're not going to do Vivix. We'll do Disney. Cold. I don't know cold, but we'll do it. So Disney seems okay. It's amazing how well they came out of the pandemic. So if you force me to take a position on Disney, I would be bullish, but cautiously so. So it would be something. Guess what? Like selling a put spread here. What I want to be conscious of is to avoid the earnings, because the earnings are a wild card that we can't control. Nic is at the helm. I had no idea I was going to be at the helm. I'm sick, people. I've got the Rona, I think. I don't know.
You're not. You have the Rona? No, you're not. You're not alone. I'm here with you. I'm just listening to you. I'm listening to the
no
space
issues.
at the
I
same
have
time.
tickers. If I have tickers, I don't need you. You can go do it.
Okay. Someone, you already went over Disney. Someone was asking about Disney.
I'm going into Disney right now. So Disney has support, and this is a trigger. So if I'm taking along now, when it's between support and a potential accelerant, I sell something. I don't want to buy something. So I sell a put spread, waiting for this to trigger, and then I'll buy a call or a call spread or shares. So this way I'm long, but I don't need a rally to happen, and time is my friend, versus buying something and say, everybody, every day, come on, go. So sell something and wait. And then that's how I would do it. Facebook, I am long. Long term, short term. What do I mean? First of all, this is my third load. The first dip, I shared a credit put spread, debit call spread, or buy shares, or buy calls, or sell puts, any combination. They all worked. And then it dipped again. We did it again. And then when it fell on Sheryl Sandberg, I was like, this is a nothing burger. I'm going long again. So I went long again. And that's what I have. So I bought calls out in time. I want to say July or August. And on the rally, I sold calls for this week, and they're dead in my favor. So now I'm going to sell them again for next week, collect another 40 cents. So now the calls I bought are much cheaper, and I still have them way out in time. So this is me trying to use diagonal. No, in this case, it was a pure calendar. So if you don't know what that is, I think now they call it the poor man's cover call, but it really isn't. It's called a calendar, where if I'm long something out here, a call, if I'm long the $210 call, ooh, what just happened? And I can sell a $210 call against it shorter time. I don't create any additional risk. I just limit my potential profits. If you've never done it before, try it on paper and don't jump in with both feet. Beep. Interesting. Okay. So let me see. Amazon after the split. Google pre-split. Google splitting too? I don't do pre-split. So I told everybody in my group, don't do Amazon before the split. If you had one contract, you're going to have 20 to close. So if you do 10 contracts, you're going to have 200 contracts to close. If you get the point, that's a lot of contracts. So if you do 20, 50 contracts, that's a lot of contracts to close. So I don't know how the Google split is. Let's talk Amazon. First of all, Amazon, great company. I'm worried for a little bit. I would not have chased it. What I said really when they asked me yesterday, I said, I want to see it act in a new neighborhood before I jump in. So I like better support. Let's say next week we dip in Amazon, I would sell put spreads down here or sell puts to own shares. If it loses this one, it's going 88 or 84. I'm not calling it there. I'm just giving you reference points. I think it has a lot of support here, and of course, these two things. The only thing that worries me about Amazon is the new management. The first two big moves, stock split and shares buyback. That's not the Amazon I know. The Amazon I knew takes every penny it has and it dumps it into buying something, into doing something new. So that's the only caveat. Let me see here. AB, I don't know what that is. What else? Do I need to scroll up? Oh, Shelly, you're welcome. Thank you for saving us. What do you want, Shelly? This is your show. Tell me a ticker. I'm scrolling up to see if anybody's threw a ticker there. We'll do Google since somebody mentioned it. I do like Google. It's an unbelievable money making machine. It's an ATM, really. So now it wants to pop, but I don't think you should chase it. I think this will be a fake out, and if you do get long, these are tough, very tough. And then you have this, which is also tough. Every ledge you lost on the way down is going to be difficult to recover on the way up. So just be realistic with how you play it and what to expect. So from here, I thought it would dip, and I thought it would do this. So it looks like it wants to do that. But what kind of resistance do you have here? I hate to sound like a broken record, but I would like to sell an iron condor on it, which means I sell risk down here, I sell risk up here, and if nothing happens, I win. This guy loses, I win on both ends. So we'll see how that plays out. Let's see. Target, okay. Hood needs a buyout. That's all I got to say. Target. Hood needs a buyout. It has 40 million subscribers. The stock cannot catch any momentum, hold any momentum. So Target is a good company. It has good reputation. The stock has done well in the past, not recently. I think they had their own downgrade, so things could not be as worse from the news perspective. And you have double bottom, two hard bounces. And I don't know how far back do we need to look at this. Holy crap. So this is, okay, October of 2020. I still don't like this down here. And this. So this is the pandemic. This is pre-COVID world down here. Not necessarily does it need to go there, but you do have gap risk and pandemic base. So let me ask you this. If the market corrects next week, you don't think that this will fill that? I think they will. So if you do get long target, leave room for error. And if you don't do options, so you can't sell a put spread, then don't go all in. Stuff is happening. All these pings. That can't be good.
Sorry, I'm just hopping in here. I was wondering if you could go back to Tesla for a second. So someone in the chat, Kaylor, was just asking about. I bought some puts on Tesla earlier while it was up like 4%. Oh, I'm snagging your screen real quick for a second.
Yeah.
So I'm up about 80% on these puts right now. I would just sell them, right? I'm up 80% in a day. That's pretty good. But I'm looking at the chart. And it still looks bearish to me. So I kind of want to hold on to them.
I wouldn't. So
okay.
Listen, if you can't book an 80% win in this market, you and I are not cut from the same cloth. So don't hate me if it depends on your personality. I would rather miss out than ruin a good trade. So
all right, I like that. I'm gonna go ahead and cut it, and then if
you have more than one put, why not at least cut one?
All right, I'll sell two of them, and I'll sell two of them, and I'll keep one.
Baller. Wait, when do they expire?
This Friday.
Okay, yeah, then I would definitely book them. What level are they at?
They are 695 puts that expire this Friday.
Okay, so here's what you can do also. If you sell two and you keep one, you can sell a put below it, probably for more than what you paid for yours. So you will be in a debit put spread that you didn't pay for.
Yeah, that's not a bad idea. I don't know if my broker will allow me to put that spread on without doing it from like the get-go, you know?
Oh, okay, yeah.
But I'll try. All right, I'm sold out of two of the contracts.
Because Tesla is probably hitting some sort of a moving average right now, and the machines will buy it. It does have an inverse cup and handle, so yes, you could still. It does look bearish, but 80%, man. I mean,
in this market, yeah, you're right. We'll take it.
Right. Also, it all depends. Did you have many wins before? Like, if I had a bad jag, and I get an easy win, I usually take it to get back on the good horse. So.
It's just one of those things where I bought it as a YOLO to begin with, so it's like, why not hold on to it and try to get like 200% gain? But I like just booking the profits. Now I literally can't lose money. I sold the two contracts for more than I bought the three contracts for. So even if this third one expires completely worthless, I'll still have made money on the trade.
Yeah. So here's the thing. the volume profile on the left should tell you that there should be avid buyers in here. So you see
Definitely.
the volume bars. So you have level support, you have a bounce level, you have volume, eager buyers there. So yeah, it couldn't cut through, but it's not an easy. It's not going to be easy. Now, if the stock market dumps, then yes, fine, it could be. And don't hate me because I told you.
No. I will not. I don't. If Tesla goes down another 3% and I would have made a little bit more money, who cares? I made money. That's the bottom line. I made money.
Exactly.
All
So
right, I'm gonna let
good
you.
job. Good job.
Thank you. I'm gonna let you take the reins again. Looks like Kevin wants to check out Airbnb.
Airbnb. Okay. So I looked at it this morning. In fact, it was on my to trade list, and I trimmed my to trade list. So good bounce. Yes. This green thing is a harmonic pattern that suggests that it could have another $20 in it, $24. However, you're going to have to contend with this. So I would imagine it stalls here somewhere, and then it tries to dip. And if it holds this level, which is 116-ish, then you have the opportunity to come back and finish the job. So what you want to do, basically, start building an ascending channel. Like, it's been in the descending channel for a long time, and like a whole bunch of other people, companies. So what you want is build some sort of a positive. So they're doing. See, I pointed to the opportunity. Let me get it out of here. This was the opportunity. So they popped above it. It's okay to come below it, but hold a decent level to maintain a higher low. So if I'm long, I can stay long, and this can go to another $20, $24, provided the market allows it. Nothing trades in a vacuum. So you have to make sure that the market is moving. I mean, it's not going to rally all by itself. So I don't mind that at all. All right, what do we? RCL, Snap. So Snap. So here's my take on Snap. I caught the dip by what? Selling a put spread. So it's a disappointing announcement. I don't get it. Why would he do that? Why would he come out and screw his investors? You don't have to pre-warn anybody, because if you do it during the earnings report, everybody protects themselves during the earnings report. And then he comes out with a surprise and especially that they had just reported like a month before that. There's no way things got so bad in a month to where he has to go out and say that. So what he said is he's going to be below the low end of the growth, below 20. He didn't say what, though. If it comes out to be like 18 or 16 or 15, I think we rally. If it comes out to be like 0 or 1 or 2 or 5 or negative, I think it could be a single-digit stock. So it's you and your gut. I sold the put spread. It will expire for maximum gains. I'm not doing anything with it. If you own it, you're stuck. I would protect myself through the next earnings via cheap puts. So if the disaster scenario happens, I'm protected. If it doesn't, then I wasted a little bit of money on insurance. You do it on your car every month, and you don't say, gosh, dang it, I didn't crash my car. No. If you didn't use your protection, that means the car is still not crashed. So that would be Snap. KO, boring. I'm probably going to say no. Well, less boring than before. So if this was wrong, somewhere in the middle lies the truth. There's really nothing to do. It is a contention zone. I think it has support. I don't think it'll go back to the highs. Whatever is going on with it is not that exciting on the daily chart. Does it pay dividends? Yes, 2.7. When you can collect almost 3% from the 10-year bond, I don't know why you should buy a stock and risk capital depreciation in order to collect less. So it is not an attractive dividend payer. You do have those daily tails that support, but if you lose them, you do have a gap down here. So if it falls to 60.5, I would be interested. If I would be more compelled to do it, but I can't even remember the last time I traded Coke. If you own shares, that's a different matter. So don't lose the base. You lose 62, I think you come down and fill the gap to another $1, $1.20, $1.30. APPH, is that Arapaho? What is APPH? No. I don't know what that is. Is that a micro cap? Yes. It has no income. So those stocks I don't do anything with. Now, having said that, I think you have sellers between 3 and 310. You have a tight battle between support at 277, 28, and 3 and 310. Let me see here. What else do we have? RCL, Royal Caribbean. Yep. So these are the last companies I want to be long. There is no way I would want to be long these companies. I have to tell you, the fans of cruising are super strong, so don't short it. The fans of the stock are super strong, don't short it. You see that white line? They're selling it every time it comes to it, right? So that's a moving average. So you don't want to be long into the moving average. So far, they haven't been able to break through. So it will come down to where fighting support versus the moving average. So 51.30 might be a good battle. Maybe you take a long down here with a tight stop. If you lose this one, I can't tell you how low it goes. They're still hemorrhaging, right? They're still losing a ton of money. And let's check how much. $2 billion in negative cash flow from operations in 2021. That is a shit ton of money to bleed. Sorry if we're not supposed to cuss. So that's a scary thing. Dell, I wouldn't touch Dell. Is it private? Is it not private? Screw that. Him and VMware, they can go to hell. I don't want to touch him. NXTP. Dell is a good company. And so was VMware. I'm just tired of these headlines. It's private. It's buyout. What is this? Why are you still trying? This time it's going to be different. I don't know what this is. You can see they're selling every pop, whatever this is. Did I get the wrong ticker? Yeah, it's dead. Do not average down in tickers like this. Super SPAC mom. Man? Oh, man. Sorry. That's okay. I called one of my people a girl, and he's a guy because he had a name that could have gone either way. It happens all the time. Zoom. I like Zoom. Cheap. You know what else is cheap? Facebook. Did you know Facebook is cheaper than Exxon on a PE basis? What kind of world is that? Cheaper than Exxon on a PE basis. What? That is a travesty. I'll do Dell. It's not fair. Christian. Okay, so pretty good support. There's no reason to short it. And if you got long here for a pop to here, you did right. Expect sellers at 51. If you can take this out, maybe you get to 51.8. Buy the dip into anything in here, unless he's taking it public or private or whatever. HimX, Lord Byron. Another micro cap. Yeah, at least this one makes money on paper. Whew, that's choppy. Dang. So it's in middle of the range. You just want to not lose that range. So here's the thing. If you ping pong inside of a range, the edges of that become accelerants. So you lose 9.3, you're gonna lose 20 cents. On the top, it's not the same. You have many failing points. So you have a lower high trend, bearish, versus the bulls trying to make a stance. Have I looked at the XLF as a whole? I have not. You know what scares me about the XLF? I'm going to give you a quiz. What is the biggest stock in the XLF, which is a banking ETF? Don't look it up. Don't Google it. I'll give you a minute. It's not a bank. I can give you that much. I have not looked at the XLF. Berkshire, yes. Berkshire. So the XLF has a lot of support below, has a lot of resistance above. I don't think it can do anything. Here's what I think. I think Powell is not going to be able to raise rates as much as he wants to. I think Powell will need to cut rates by December like he did in 2018 or January. Wrap your head around that. I'm not an economist, neither is he. So I think my opinion was just as good as his. He's destroying the economy, which is shocking. But anyway, on purpose, that he built. He helped build. So anyway, banks in general, there's nothing to do with the XLF here. It has support. It has resistance. If you force me, I'll just sell an iron condor and just let time do the work. But there's not enough premium in this one. I wouldn't trade it. Pick a company in it. Like JP Morgan has decent premiums. Goldman Sachs is pretty exciting because they're bank, not bank type of deal. They always have shady stuff going on, so it might be. Citigroup was on my radar several times. You know what the scary part about Citi, though, is that overseas element that we don't know anything about. I'm always worried about it. It comes out, oh, they did deal with such and such. So this was it was a definite buy the dip moment in Citigroup, and I wrote it up a couple of times, and it started to play out, and then it fizzled. Started to play out, and then it fizzled. But here's the important thing: is maybe they're done selling rallies. So they were stuck in this vortex of selling rallies. Maybe they're done. Now they're buying dips. Dip bought, dip bought, dip bought. Maybe they can sound like a song. They can start doing this. Brock. Okay, so bro holding a lot of Bank of America. He got them from warrants. He lent them money on a note that was convertible during the 08 debacle, blah, 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 blah. He didn't just go out buying shares. And here's the other thing. We are not Buffett. We cannot trade like Buffett, and he's like 1,000 years old. So respect, but I don't think he's doing much of the trading right now. RK, I would avoid. I mean, pick the companies that are in there. The top 10 companies in RK are half of it, and that includes Tesla, Spotify, Baidu, Baba, I think, Square, Roku. Roku was a great buy. Great buy. I bought the dip in Roku when everybody hated it. Just avoid it. Here's the thing. Whenever somebody on Wall Street displays their trades, they go after them. You remember Ackman? You know, when he shorted the Herbalife, everybody went after him. She says, here's my book. They say, okay. All right. What else is happening?
Yeah, we had that Roku news today, potential buyout. I see Brian wants to look at ARK, ARKK.
Yeah, we did that. Keep up, man.
We already did that? Sorry, man. Something I'm interested in right now, Nick, are the airlines. Have you been watching the airlines at all?
I did. I looked through them this morning. I did a whole bunch. I like, excuse me. I like Southwest because they were built on lean margins. That was their thing. No frills airline. Versus the other ones are trying to come to terms with that. So if you look at it, it's consolidating well. It would be the one I would bet on. But I'm not going to risk any upside money on any of these guys. They run a horrible business under normal circumstances, and add to it the pandemic and all of the wrinkles that come with it. On dips, I would buy the dips into support. Right here, if I buy it or sell it, I am making a guess. I have no idea why it would go down or why it would go up. I just realized I'm not sharing my screen. Am I? Yes, I am. So you have limits at 42 and limits at 36. The only thing I can do with it is sell risk against both and let time do the work without taking any risk through an earnings report. So didn't they just cancel 7,000 flights during a travel weekend? So I'm not anticipating any good things from that. So I would not invest in the. I would buy dips if they happen, but I'm not going to buy it here and hope for the best. So let me see if I go to a 15-minute chart. Okay, so you have support. So the first trigger is 38. You lose 38, you're going to go lower. How much lower? $1.80 from 38. So that's a tradable thing. So here, the way I would show it, no trigger, no trade. So don't look at that. That's an iron condor, by the way. So if it doesn't fire, don't take it. But if it does fire, you can probably get to here. Look at that. Perfect. I didn't even know. Perfect. And conversely, if you take out this, there's an immediate fake out. So use this or that as a trigger. So I'll put it here. If you do this, maybe you'll go to here. Let's see. Perfect. There's sellers hiding right here. That's why I put that there. So if we go to 30 minutes, 60 minutes. Okay, so this is what we just did. We just range bound it. It's ping pong inside of this. If the range breaks, they go a little bit this way or a little bit that way. If you don't do anything and it falls, you can catch the dip. If you don't do anything and it rallies, you can buy a put or put spread. And how do you manage that? If they go above where you thought they were going to fail, you say, I was wrong, you get out. Hood. I got stuck with Hood. I sold put spreads and I forgot I had one contract left and I got stuck with 100 shares. I'm underwater for sure. So I'm hoping for a buyout. It is what it is. I mean, they have 30, 40 million subscribers. I just got an email from them. They're hiring. So that's a little bit of inside information. I replied. I didn't know what they were asking me. Do they want to contribute on the platform or what? But anyway, I think they're looking for full-time positions. So that's good news. Struggling companies don't hire. Technically, they have resistance 9 to 920. Proposed SEC. Okay, I don't know the changes, so I'm sure it would be affected. The changes are on what? Crypto or regular stocks? Oh, I see. I think I know what you're talking about. The no fee thing, and they make money on the back end. They'll figure it out.
All right, Twitter Space is officially over. You have my full attention now, Nick. We only got 5 minutes left.
Well, aren't I lucky to walk? Aren't I lucky?
No, we've been lucky enough to have you. I know it's.
No, I saw your email. I was like, shit, I forgot.
I appreciate you coming on even while you're feeling under the weather. But guys, Nick is one of these guys with options that is just an absolute monster. I saw in the chat someone saying he rings the register. That's what Nick does. That is his job. If you guys want to learn more from Nick, you got to sign up for the Benzinga options.
This is what you have to sign up for, not just the options. So every day I share my screen. Right now I'm sharing my screen. They're looking at it as like, is Nick on mute? Is Nick on mute? Because they can't hear what I'm saying. So I have 290 people in there right now. We break between 320, 318, and 260. We are like, when I'm not there are people contributing with their own trades. And look, see, watching my screen. Just today, we nailed a whole bunch of trades. So right from the get-go, people like Liz comes in, a young person, buys the dip. Is it okay to buy the dip in the SPY? Yes. And then books it and then comes back. Is it okay to rebuy it after the dip? I said, yes, but you got to book fast. Hopefully they did book it. I haven't read. So this is what's the exciting part. So the options is all good, but get in because I can guarantee you, I guarantee it. And in fact, if I don't deliver, they will give you your money back. I guarantee you'll become a better trader. Whatever version trader you are, you will be a better trader because of the conversation that happens in there. It's at a high level and it's totally fun. There's not one jerk among the bunch. There is one jerk. He pops in every once in a while and heckles me and leaves, but what am I going to do about it? But other than that, it's a good environment. So if you do sign up, please opt for the chat because that's where the money is.
Yep, and you guys got to do it. I'll post that link in the chat. Should be in the description as well. Nic, always a pleasure to get you
Thank
on
you.
the show, and I
Thank
hope you start feeling better. I hope it's not COVID.
I don't know. I am going to use one of my, you know, I got the crack pipe and the testing thing, so I'll use the testing thing.
And not
I'm
the
going to
crack.
use it.
All right.
All right. Later.
Take care. All right, guys, that was Nic Chahine again. I'll drop that link in the chat for Benzinga options. Inner Circle, you guys need to go ahead and do that, because if you're like me and you know you're throwing out some YOLO trades, the best way to get actually better at it is to learn from a guy like Nic. So I'm gonna go ahead and throw that link in here. I know today was a little bit of a different day because we were streaming that Twitter space that I was helping co-host, but shout out to Mark Moran, shout out to Liquidity for putting that on. I think it's always fun to get a real bull versus bear debate, and was a very much a fun thing to do. So again, I know not a typical show. Let's just do another quick check in on the overall market before we wrap up here. Okay, actually, I'm glad that I got out of those Tesla puts with Nic, because now Tesla's moving higher. S&P 500 is down exactly 1% right now. The Qs are down 0.6%. So tech a little bit stronger than the overall market. Let's check in on the Dow Industrial Average. The Dow is down 0.9%. Wow, so rare to see Dow down more than the Qs are on the day, but that's where we're at. All right, guys, 2 o'clock, time to wrap up the show. We will be back tomorrow. Stick around for the roadmap, talking about some cool NFT projects coming up right now. So don't go anywhere. We'll be back tomorrow, 11:30 a.m. Eastern. Love you guys.